the market just isn't convinced that we've made enough progress yet.
It'll be a busy summer down in D.C., and the bond market, I think, will have to pay attention through the summer.
Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained.
If we do get wage growth, which I think is coming, I think inflation is going to be a problem.
Once you have jacked wages up, then it is very difficult. You almost never see in any country around the world wages begin to go down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures this Monday morning up 2 on the S&P 500. We advance 0.05%. Tom Keene, pushing ahead to payrolls Friday.
Pushing ahead in a great bull market to payrolls Friday. Early report here. Wicked early, John. When you're up in Maine, you say wicked a lot. Wicked early jobs report this month. I believe it's July 2. That would be a Friday. And, John, the basic research tone I got over the weekend was optimism.
700K is the estimate, Tom. The range wide, wide, wide. $1 million at the top end, 400K at the low end. 20-foot sign, we have no idea. That fits in the middle of that.
Wait, I thought that was our slogan.
That is our slogan for the next 3 hours. It's a Friday. We have no idea either.
I tried to get a hold of you this weekend, but you wouldn't talk to me. You know, I'm getting too small.
I thought I'd let you take a break.
Thank you. Well, I took a break.
Away.
What I saw, John, to go to the jobs report is everywhere. I put one image out on Twitter. Everywhere you go, it is help wanted. It's help wanted with a desperation. There was one restaurant. I was supposed to have lunch with Gerard Cassidy of RBC Capital Markets. I show up at the restaurant, and he goes, no, he stopped by, he left. And they had half their restaurant shut down.
For people who don't follow Tom's Twitter account, you probably wonder what on earth he's talking about. Tom was away in Maine for 4 days. Thank you, Tom. Number of the week going into payrolls. Lisa, a little more than 9 million job openings in the United States of America.
A question as to why the friction persists, why some of the people who are unemployed are not getting back in. The Wall Street Journal writing a story highlighting how a number of states that have already removed the enhanced unemployment benefits are starting to see a pickup in the number of people applying. This is highly controversial. The idea of how politicized this report really will be, John, as we deal with some of those frictions.
We'll discuss that through the next several hours. Let's get you to price action this Monday morning. Coming off the back of the biggest weekly gain since February on the S&P 500, 42.73 on the S&P, all-time highs in the equity market in America. We advanced just 2 points this morning. Outside of that, euro-dollar unchanged at 119.39, and yields come in about a basis point, Lisa. Biggest weekly sell-off in the Treasury market going back to March. Your yield, 151. 56.
Which really raises a question about the direction of yields. And frankly, we'll be talking about that through the rest of the week, especially if the marginal potential data that we get out of the labor market later this week actually highlights strength versus weakness, how much that will actually have a huge effect on Federal Reserve officials, including one of the big three, New York Fed President John Williams, who's speaking today at 9 a.m. at this virtual BIS panel.
What's he going to say different than his interview with John Ferro and Michael McKee? Seriously.
Absolutely nothing. However, there could be something that he could say that actually is relevant, and it's worth highlighting that there are certain Fed presidents that are worth paying attention to more than others. And that was sort of my point. The idea here is that some of the regional Fed presidents are talking as well today, but we're not highlighting them because it's ultimately coming down to the big three: Rich Clarida, John Williams, and of course Fed Chair Jay Powell. Today, also, Joe Biden will be meeting President Biden of the United States, meeting with outgoing Israeli President Reuven Rivlin. Interesting to me, especially coming after those airstrikes yesterday on Iranian-backed militias in Iraq and Syria. The idea here is how much could this jeopardize the Iranian nuclear deal that, frankly, Israel has been highly opposed to? Could there be something that comes out of this that does give some indication about where those talks are going? And today, after the markets close, after 4:30 p.m., the biggest U.S. banks will announce their capital distribution plans. The expectation could be for the biggest 6 U.S. banks to announce more than $140 billion of distribution. My question really wants to go back to what Mike Mayo said last week. The idea here that some of these bank stocks are now yielding more on just a dividend yield basis than high-yield bonds, than junk bonds, John. This changes the scenario as to why people sometimes want to own these securities.
Lisa, the banks last week had a massive week, up by 6.5%, bouncing back from the losses from the previous week. Do you think that was connected to this or the fact that yields kicked higher through last week too?
And to build on that, I don't have an answer, which is the reason why I'm not going to necessarily answer it. But to build on that, the question is, how much can the fate of bank stocks diverge from the fate of the yield curve just based on the dividends? And so far, it seems like it's hard to sort of pair out the correlation between the two.
John, we're in a bull market. I wish, you know, like you mentioned, John, record high SPX, NASDAQ 100 up 0.2%. Right now, there's 87 reasons why we're supposed to go down. John, we haven't.
Banks have had a tidy year, up by 28.74% year to date. I want to turn to Laurie Calvasida, Tom, RBC Capital Markets, head of US equity strategy. And Laurie, let's start there. Do we want to stick with what's worked so far this year, energy, the banks, for the second half too?
It's a great question, John. We spend a lot of time on that in meetings. And look, I think that the leadership backdrop is getting a little bit choppier, but I think at the end of the day, there's still a lot of room in the cyclical value trade. So your poster children of that are going to be things like the financials, energy, materials. I might be a little bit cooler on the industrials. I don't think you have the same valuation opportunity in industrials, though you arguably have some, catalysts from the infrastructure bill. But I think that you still have a lot of room in these banks in particular. It's regularly one of the cheapest sectors in the market. We've got catalysts now in the form of what are probably going to be pretty big buyback announcements coming. And I think that the underlying economic data is going to continue to run pretty hot. I think there are going to be some wobbles here, which might kind of keep some of that leadership, moving back and forth day to day, week to week. But at the end of the day, this economy is running very, very hot above long-term averages. And that should push you into these cyclicals for a while longer.
Laura, readjust market cap right now. Do you go to mid cap, small cap, or do you barbell mid cap, small cap with selected big cap?
So I think that you want to go down into mid cap if you're a large cap manager, and if you're a multi-cap manager, you do want to go all the way down into the smaller cap stocks. And there are a couple of reasons for that. One, if you just look at it at the broader index level, these companies are still inherently more cyclical than the big cap companies. So you're getting more exposure to that, kind of hot U.S. domestic economy. And also, frankly, the valuation appeal is there. We've been in this world for the last decade or so where large cap growth, mega cap growth has dominated. If you look at the relative valuation multiples between mid and large or small and large, frankly, they're still pretty astounding. There's still a lot of valuation runway here.
Laurie, how do you make sense then, given your call on the rally that we've seen in the 10-year, notwithstanding last week where we saw the sell-off? The idea here that the balance seems to be toward lower yields. How does that cohere with his view towards cyclicals like financials, which depend on higher yields?
Look, I'm an equity strategist, but when I talk to my friends in the fixed income world, they do a very good job of convincing me that the yield is not necessarily reacting only to macroeconomic conditions, that there's also a positioning issue at play. And I know that in my work, whenever I look at anything from a tactical asset allocation perspective, so I look at the household balance sheets, for example, or if I look at tactical asset allocation funds tracked by Morningstar, I see very, very low bond exposure and very, very high equity exposure. So I do think that there is a lot of truth to the idea that there is some positioning at play in the yield.
Well, let's talk about the positioning in your world. Energy up by more than 46%. On S&P 500, energy on that sector. We talked about the banks briefly a couple of moments ago. Laurie, you do some tremendous work on ownership. Who owns this story? How well owned is it? How well owned is that story right now?
So let's take energy first, because I think that's a little bit different from the financials or the materials. If we look at energy, it's actually hilarious, at least if you're a data nerd like me, because every positioning study I run, everybody does their best to stay neutral to the energy sector, whether I'm looking at large cap value funds, growth funds, small cap funds, hedge funds, S&P 500 benchmark funds. Everybody just hugs the benchmark weighting here. And I think that's because commodity prices, are difficult for equity folks to predict. And I think, frankly, a lot of equity folks have been burned over the years trying to make big bets on commodity prices. So they try to, just really hug the benchmark. If you look at the Russell reconstitution, one thing we heard sort of in forecast season was certain managers were seeing energy going up in their benchmark weighting. And they're like, well, I don't want to be overweight this sector, but I need to own another stock. I may have a small position. I need to add a little bit more. I think if you look at the financials, it's entirely different. The large cap long onlys have been there for a long time. Frankly, it's something that's really impeded their performance in recent years, and it's working out for them now. But if you look at hedge funds, they were deeply, deeply underweight at the end of 1Q, and they actually got more underweight, which is the exact opposite of what you would have expected. So the financials, if the hedge funds ever come back in, I mean, get out of the way. They're going to bid this space up in a hurry.
Lori, is Amazon, Apple, the rest of them, are they part of your valuation runway?
So look, when we look at sort of the tech space or the communication services space, I actually have a basket of TIMT, tech, internet, media, telecom. I grew up in the kind of aftermath of the tech bubble on the street.
My deepest sympathies.
We started out thinking it would be the craziest thing, we'd ever see in our careers, and it just has gotten crazier and crazier. But that's another tangent. But look, at the end of the day, I think the fundamentals in that space are unbelievably strong. And I think the secular growth appeal is there. I think that there are two problems with that space today. I think number one, you just don't have the same valuation opportunity. Now, you've gotten better valuations as the year has progressed, but we just don't see cheap valuations versus the S&P. And that's important because for much of the big bull run in that TIMT space, from the financial crisis up to kind of that pre-pandemic era, we did see cheap relative PEs. A lot of people forget that. It wasn't just about the secular growth narrative. And I think the problem today, when you think about the fundamentals are fine. They're just not all that special. They're just not all that unique. And that's where I go back to this idea of a hot economy. In the aftermath of the financial crisis, we really didn't get a lot out of Washington. And we had an economy that ran cool, below average, below the 2.5% long-term run rate for quite some time. And that's really the kind of environment that secular growth does well in. But right now I'm looking down the barrel of, kind of 6-7% GDP this year, 4% plus next year, getting back closer to average, frankly, in 2023. But it's just not the same kind of post-crisis environment that we had back then. And these secular growth names, they're just not that special anymore. That's the problem with them right now.
Lori, you're special. We love catching up with you. Lori Campbell,
the sensitive Ferro.
RBC Capital Markets, head of US equity strategy. I start happy on Monday, I think, and then progressively get worse as the week.
Yeah, like 2 p.m. Monday afternoon.
Something like that.
This is a happy John Ferro.
This is it. The word crazy that Lori used briefly there. Let's pick up on that word crazy. Lisa, we had Centene selling $1.8 billion of junk bonds last week. Here was the yield. Reportedly from the team, Alex Woodenberg running this one up, 245 on high yield debt. 245.
That's high yield, not so much. And this really raises a question. Why not just buy stocks, especially with the dividend yields?
There we go.
John, number of the week, lobster roll, top tick, $39 a lobster roll.
$40, really?
That's the statistic.
Triple leveraged lobster rolls.
Wow.
You got to be. I'm going to become a lobsterman. Can you see me out there?
Are you broke already?
Don't ask
at the end of June.
I'm going on air. I didn't get 8,000 shares at GameStop like you.
42.72 on the S&P, all-time highs as we count you down to payrolls Friday. Beautiful morning in New York City. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. U.S. airstrikes on Iranian-backed militias in Syria and Iraq have come at a delicate time. The Pentagon says the raids were aimed at deterring future attacks on U.S. interests in Iraq. Iran's president-elect Ibrahim Raisi takes office in August. He's been seen as someone who'll take a harder line against the U.S. Meanwhile, talks on reviving Iran's nuclear deal have dragged past initial timetables. 3 Republican senators say President Biden's infrastructure deal is back on track. There was concern the deal could fall apart when the president linked it to a larger tax and spending bill that Republicans opposed, but the president walked back his remarks Saturday. Republican Senator Rob Portman says work on the bipartisan legislation can move forward. The new British Health Secretary Sajid Javid says he wants to see the country return to normal as soon as possible. Javid, the former Chancellor of the Exchequer, replaces Matt Hancock. Hancock quit over the weekend after he was caught embracing an aide in his office, a breach of the social distancing guidelines he helped create. And Bloomberg's learned that UBS will permanently allow as many as 2/3 of its employees to have a hybrid model of working from home and the office. It's an attempt for the Swiss bank to be more competitive in recruitment. Many US banks have taken a more hardline approach. And it's a major blow to Tesla's operations in China. The government has ordered that almost all vehicles the electric car maker has sold there be fixed to address a safety issue. That's more than 285,000 cars. Chinese regulators say Tesla's autopilot system can be activated automatically. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
I was very glad to see the president clarify his remarks because it was inconsistent with everything that we had been told all along the way. We were all blindsided by the comments the previous day, which were that somehow these two bills were connected. I'm glad they've now been delinked, and it's very clear that we can move forward with a bipartisan bill that's broadly popular, not just among members of Congress, but the American people.
That was Senator Rob Portman of Ohio speaking on ABC this week. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Monday morning, equities near all-time highs, 42.70 on the S&P. We pull back by a single point on the S&P 500. Euro-dollar unchanged at 119.38. Your 10-year yield comes in almost a basis point after the biggest weekly sell-off in Treasuries going back to March. 151.73 is where your yield is right now. So, OK, drum roll. Let's head down to D.C., Tom, and try and make sense of this. The president puts out a statement on Saturday and says that his comments, quote, created the impression that I was issuing a veto threat on the very plan I just agreed to. That was certainly not my intent. Now, Tom, I'm trying to work out what was the intent over the last week.
It was on the edge of British politics. That's about all I figured out, John. Absolutely bizarre. You know, I look at it and I look at infrastructure, and all I can say, folks, if you want to see the effect of infrastructure, if we ever get it done, stop by LaGuardia Airport, which is going from worst to best in short order here with a huge rebuild program. Anne-Marie Horton with us in Washington on the rebuild program. Anne-Marie, what's the likelihood we get an infrastructure program after what John describes this weekend?
Good morning, Tom. Well, what's so interesting about it, and you listen to all the Sunday shows, Romney, Cassidy, Portman there, he has the Republicans on board for this $579 billion hard infrastructure deal. The problem I think the president has now is actually members of his own party. Speaker Pelosi really put a red line in the sand saying she's not going to even bring that hard infrastructure bipartisan plan in her chambers until the Senate goes for the multi-trillion-dollar large infrastructure plan. This has part of the Families Act, things like Medicare. But there is bipartisan support now. Republicans are on board with it. So it's likely we could see the hard infrastructure. The reconciliation bill is really where the question mark is.
Does the Speaker represent the progressive liberals in the House, or does the Speaker represent the middle ground?
She represents, I think, with this hard line in the sand, this red line, represents the progressives in the House, saying that she will not even consider a vote on this bipartisan deal until they get the larger spending package. And this is really what the progressives now are pushing the White House. And you've seen some of these progressive outlets even start up websites over the weekend saying no deal unless there's more on climate, unless there's more on Child Care Act. So they're really pushing the White House to lean more into the progressive agenda that they were hoping to see championed by the president.
So, Anne-Marie, the president starts a tour this week. He goes to Wisconsin first. What's the objective there?
The objective, John, is really just to get the American people on board. One, for the hard infrastructure, but also, I think, really explain why the Democrats are pushing for a more wide-ranging infrastructure plan, what they call infrastructure in terms of human infrastructure, child care, Medicare, and higher taxes. So really, it's just to drum up support. Remember, it's July now. The Senate is out on recess. Then the House will go before July 4th on a recess. And then August is pretty much the entire city is dead. From what I hear, I'm new on the ground, but everyone said pretty much D.C. is dead in August. So they have July to get this done, or the fall. But pretty much it's now until the end of the year, because then all of D.C. is going to focus on the midterms.
Anne-Marie, I've got to say welcome also. And the idea that you're coming in with a bit of a bigger view is actually wonderful for us. So can you answer a really basic question for me? I still don't have a sense, after listening to all the Sunday talk shows, of whether the president is going to veto any kind of bipartisan deal if it is not coming alongside some sort of larger spending, as potentially $6 trillion is crafted by the absolute most left wing of the party. What's the verdict?
Well, everyone that went out to go to speak for the president, Lisa, it's a really good point, was towing this line of he's not going to veto it, but everyone just kept saying they're going to be done in tandem. There's going to be a two-track. Even Joe Manchin saying we'll get reconciliation done, but he wouldn't put a price tag. He was willing to vote on it, but everyone said there's going to be a two-track. No one wanted to mention a veto, and no one wanted to say hard infrastructure's out the door if we don't get the reconciliation bill. So I still think they are working on their communication, but the president's statement on Saturday made it clear he would not veto this bill. I think it would look pretty bad for the president and the Democrats if they were to get a bill on his desk for hard infrastructure that has a lot of support around the country, and then he just vetoes it after you see him there outside the White House with a group of bipartisan senators talking about this deal.
I look where we are, Anne-Marie, and it's today. Now, the heat is on in Washington. There is recesses or almost recesses. What will be accomplished this week?
This week, Tom, I think is just going to be, back and forth within the House. The senators are on break, so really it's about the House drawing up this discussion on the reconciliation bill. But I don't expect much at all to be accomplished this week. And as John said, really this week, I think the focus would be on the White House as they tour the country to try to drum up support for this mass spending.
That was a pretty sad welcome for Anne-Marie that you delivered, Tom Keene. I'm very unimpressed. Anne-Marie, welcome to Washington, D.C. Anne-Marie
Got here on Infrastructure Week.
I was away. I thought she was on last week.
As Lisa points out, Anne-Marie, you'll get used to those. You'll see them again and again and again. Hopefully this really is it this time.
Can she do a remote from Ben's Chili Bowl?
That would be nice, wouldn't it?
I mean,
we're going to join her.
Yeah, absolutely.
Yeah. Obviously.
Anne-Marie, run. Good to catch up. Anne-Marie Horton, Bloomberg, Washington correspondent.
Actually, you could do it from the Hay Adams bar. That would work as well.
I'm sure, so long as the drink is involved, Tom. Anything would work.
Thank you.
Headline crossing the Bloomberg: Hong Kong to ban flights from Britain again from Thursday. This, Lisa, coming from the South China Morning Post.
Yeah, and it comes at a time when the UK is reconsidering how long it's going to remain with its restrictions in place. The Delta variant really front and center, having a serious impact on people opening up borders. I just don't have a sense of what the threshold is anymore, John.
Oh, neither do I. And clearly the threshold from country to country is very different. We'll hear from John Hopkins a little bit later this hour. But, Tom, here we are once again for the airlines, for the travel business. They were gearing up for a better summer in the Northern Hemisphere.
It's not happening.
It ain't happening in the way people thought it would.
You know, I think we've been out front on this. I take great credit to our team, and particularly from Johns Hopkins on this Delta variant, this India variant. I mean, my basic take is, John, over the weekend it grew out. Look at Australia. Shocking. Shocking in Australia. There's no other way to put it.
Well, Lisa's word, I think, is the useful one. Threshold. Quite clearly, Lisa, in Australia, there is a very different threshold.
Yeah, it's a much lower threshold. And frankly, in Asia, there's been a much lower threshold before restrictions come into place. In the U.S., even though the Delta variant is spreading in Los Angeles and in California, people don't seem to care as much. It's sort of part of doing business. And this has to do with the vaccination rate.
That headline coming from the South China Morning Post: Hong Kong to ban flights from Britain again from Thursday. Let's check the price action for you this Monday morning. Equity futures 42.69 on the S&P, pulling back by almost 2 points. No drama here, almost totally unchanged, negative by 0.05%. Outside of that, into the bond market, yields 151.56. Yields coming in about a basis point. Going into payrolls Friday, your estimate 700k. That's your median in our survey, at least. At the low end, 400k. At the top end, 1 million. Euro dollar 119.38, and crude just about holding on to a 74 handle. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg Surveillance. From New York City this morning, good morning. All-time highs coming into Monday morning. Equity futures this morning, 42.70. We pulled back by about a single point on the S&P 500.
Go to cash.
A single point on the S&P 500, just to emphasize that. Lisa, a little bit earlier, mentioned the fact that after the close today, we'll start getting that drip feed, maybe that avalanche of announcements from the big banks on Wall Street looking for capital returns a little bit later. I'll run through the numbers a little bit later too. Switch up the board and get to the bond market, 2s, 10s and 30s. Last week, we had a really nice week for equities. The biggest weekly gain on the S&P 500 going back to February. Had a nice weekly gain on a 10-year yield as well. The biggest weekly gain going all the way back to March. Yields higher by 8-9 basis points, getting back up to 151.56 on 10s. Yields come in this morning by about a basis point on both 10s and on 30-year yields as well to 21.38 on on a 30-year yield, 2.138%. I want to finish in foreign exchange, Tom, and go through the range for you. 118.48 is the low end of euro dollar this month. 122.54 is the top end. 122.54 is actually where we started the month of June. Right now, intraday, 119.40. Totally unchanged there too, Tom. So a bit of a snoozer to kick things off Monday morning, going into payrolls Friday later this week.
I agree with that totally. I mean, I tried to make some news out of foreign exchange folks, and I couldn't get there. Ibn Barbari at Citigroup re-emphasizes weak dollar, but he's struggling across all assets to devolve it down, if you will, to foreign exchange. Right now, we're going to do that. And of course, here in the last week of the second quarter, there's a lot of focus on the view forward, everybody trotting out global outlooks. Daniel Ons at BNP Paribas is unusually smart. We're thrilled he could join us this morning. Daniel, I'm going to go right to the dynamics you set up, which is that equities will cope with higher yields. Many of our viewers and listeners are like, right. Why will equities cope with higher yields?
Yeah, good morning, Tom, and thanks for the shout out to our new quarterly global outlook. Yeah, indeed, one of the main themes of our global outlook is that this is going to be a tantrum-less taper in contrast to 2013. We think that there's a couple of factors for this, but the main one is that the Fed has really, I think, communicated well in advance that they're now thinking about tapering, and they're going to continue, I think, to be as transparent as possible about this. And second, it's just been policy. This is a very unusual recession. It's not a financial leverage-driven recession, and we've had very aggressive fiscal and monetary response to all of this. I think this all shapes up together to be a positive outlook for risk assets.
What does BNP Paribas see in terms of GDP? You have a legacy back to Julia Coronado of really being cautious on expanding out GDP. What is your 2021 adjustment, and what do you see for next year?
Yeah, I think this time we're actually above consensus. We have growth at 6.9% for this year and a 4.7% for next year.
Wow.
That's pretty hefty, but I think not unreasonable in light of both the still kick that we're going to get from reopening of the economy, more stimulus checks or fiscal support for families with children starting in July. And lastly, as the news kind of focused on over the weekend, probably a pretty sizable further fiscal expansion focusing on infrastructure, both physical and human.
So as we monitor the moving target on Wall Street, 6.6% for 21 is the median estimate right now for GDP growth in America, decelerating to 4.1% in 22. Dan, as you just point out, you expect a smaller degree of deceleration from 21 into 22. You also do the markets coverage too, so supplement the market call with the eco call going into next year.
Yeah, again, on the econ call, it's a really a story of the economy is, we think, in seeing all of these tailwinds for the reasons I mentioned earlier. But it's also the Fed not trying to puncture this expansion with overly preemptive strikes against the prospect of inflation. I think despite the what I think markets kind of conceived of initially as like a hawkish pivot from the Fed, they have, I think, signaled that they're now again thinking about tapering. But I think the markets overly kind of read too much in the dots. I think the testimony from Chair Powell sort of reinforced that they really haven't changed their underlying strategy, which is that they're not going to be doing preemptive strikes anymore. They are going to wait for the data, especially on inflation, to bear out. And while they are perhaps more optimistic that inflation will be sustainable, they're more optimistic that they'll get to maximum employment sooner. They're really going to wait and no longer try and move in anticipation of that positive growth.
So, Dan, when you sit around the table with a team at BNP Paribas, what is the market call that goes along with that?
Yeah, so again, I think the market call is one where there's going to be this tantrum-less taper. We think we're still constructive for equities. We do think that nominal yields will continue to rise, but in a fairly gradual way. and we see some kind of steady, perhaps weakness in dots, but not the kind of market turmoil again that we saw in 2015.
Dan, does it concern you that that's increasingly consensus?
Yeah, I mean, I think there is always sort of risks on any outlook, but I would say, if anything, the risks are probably on the side of perhaps even more growth than we had penciled in. We have we shouldn't forget there's more than $2 trillion of excess savings sitting on households' balance sheets waiting in the wings. We have underlying our forecast a rather gradual kind of release of a lot of that back into the economy. But, maybe people decide, this is great, let's go out and spend even more. The other risk, obviously, that everyone is talking about is all this inflationary pressures that we're seeing. And while I think we recognize that some of this is more persistent and not purely transitory, we actually think that's a good thing. This is exactly what the Fed wants to see, and this will bode well for the success of their new strategy, and arm them well for the next cycle that comes around.
It's interesting, John. The reason why I ask that is because MKM Partners' Michael Darda put out a survey over the weekend where basically he was saying, what's the biggest threat to current stock market valuations? And John, it was sustained inflation. What do you expect from inflation? Surprise to the upside. What's the biggest 2022 wild card? Fed tightening. Hawkish, hawkish, hawkish. Better than expected, better than expected, better than expected. These are the consensus ideas. What about the potential downside risk from perhaps weaker earnings? How much is the market not positioned for that, even though Treasury yields are as low as they are?
150, 156 on a 10-year. So let's pick up there, Lisa. The 10-year topped out at the end of March. We talk about that often on this program at 177. We've still got a year-end forecast, the median, surveyed by Bloomberg, looking for 188, Lisa. 188 is still your year-end call from the street.
Well, and this is the concern for me. And I know that, Tom, you were highlighting earlier today this idea about how much you would have lost if you continued with your fear trajectory. And yet the fear is still baked into Treasuries, even though it's not into the consensus outlook.
Yeah, the overwhelming thing here, I don't have the chart up now, it doesn't matter. What you need to know, folks, is we're up a blended 14% in the first 6 months of this year. Daniel, on chapter 23 of Ec 10, nobody reads the chapter at Harvard, and it's just simply this: the markets matter. What is the symbolism of an up 14% equity market in the last 6 months against all these many walls of worry?
Right. If anything, the fact that markets are worried about this thing perhaps is, in a kind of counterintuitive way, a source of at least more confidence that there isn't, irrational exuberance inside markets. But getting back to the inflation, which again I think is the biggest risk here. We also had actually a flash survey during our Global Markets Americas conference a few weeks ago, and the plurality of respondents saw inflation at somewhere between 2 and 2.5% next year and into 2023. Our keynote speaker, Dr. Ben Bernanke, was actually very impressed at that. He said that that's exactly what the Fed is trying to do here. And I think there's actually quite a lot of confidence that the Fed is going to be able to thread this needle. Now, always markets and reality throws curveballs. That there's inevitably going to be, I think, volatility coming. But nevertheless, again, I think you just talked about the consensus forecast for 10-year yields. This is actually, in historic terms, very, very accommodative financial conditions. That's still negative real interest rates. I think I see more tailwinds rather than headwinds at present.
Danan, good to catch up as always, sir. Thank you. Daniel Nam there, the BNP Paribas chief US economist and head of Markets 360 North America. Just getting some confirmation of that news out of Hong Kong. So here are the headlines. Hong Kong to ban all passenger flights from the UK from July 1st. Hong Kong to classify the UK as extremely high risk. So Hong Kong is to reclassify the UK as extremely high risk. Tom, sterling coming in just a little bit, still positive on the day. up by about 0.2%. Stronger pound, just about 139.03.
You wonder where this is going. I mean, John, I think there's great uncertainty. I know we're going to talk to Joshua Sharfstein here in a moment, but John, to me, it's just uncertainty within the celebration in America that science works.
I have no idea where it's going, but I will say it's not going in the direction right now that people anticipated several months ago.
Yes, or weeks.
And Lisa, that matters.
That matters a lot, especially in places like Israel, where there is a significant proportion of individuals who are vaccinated. And there was a recent study coming out of that nation over the weekend showing that people who were vaccinated still getting sick with the Delta variant. I think ultimately, John, this comes down to the threshold. At what point do we treat this if there are no hospitalizations and no deaths like the flu?
Joshua Sharfstein is going to join us next to weigh in on this. Johns Hopkins Bloomberg School of Public Health Vice Dean. A timely conversation just moments away. In your equity market, a little bit of a bore, I've got to say. It's down 2 on the S&P, just off all-time highs at 42.69, negative 0.05%.
Just a snooze fest.
I don't believe you, Tom.
Look at Brent crude. Come on, sustained $76. Get excited.
Just south of 74, 73.95. And yields, Lisa, in a whole basis point.
Oh, my gosh.
151.39.
Where's lobster roll in your data chat?
Would you like me to get that up for you?
Leverage lobster roll.
I'm sure we can find some data on the Bloomberg for you.
Yeah, Al from New Jersey says $27.
In New Jersey.
In New Jersey.
Okay.
Way below Maine.
Tom Keene.
It's also 6 days old, but hey.
Lisa Abramowicz. I'm not going there. From New York City, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The U.S. has launched airstrikes on Iranian-backed militia groups in Iraq and Syria. The Pentagon says that's to deter future attacks on U.S. interest in Iraq. Those attacks could be an early test for Iran's President-elect Ibrahim Raisi. He's been seen as someone who will take a harder line against the U.S. than departing President Hassan Rouhani. In South Florida, rescue workers are digging for a 5th day in the rubble of a collapsed condo building. They say they could still find survivors. 9 people are confirmed dead and more than 150 are still missing. The last live person was rescued Thursday, hours after the collapse. The UK's financial watchdog has banned Binance markets from doing any regulated business in the country. It's one of the most significant moves yet by a regulator amid a global crackdown in the crypto industry. There's been concern about potential involvement in money laundering and fraud. Binance Market is an affiliate of Binance, the world's largest crypto exchange. United Airlines is preparing to make one of the biggest jet purchases in its history. Bloomberg's learned that United will buy more than 200 narrow-body planes from Boeing and Airbus. The deal includes about 150 Boeing 737 MAX jetlines and more than 50 Airbus 321 Neos. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This virus seems to be spreading much faster than even the Alpha variant, which was our big concern during the winter months here in the U.S. It'll probably be the dominant virus lineage here in the U.S. within a couple of weeks, and that sets us up in the future, meaning in the fall, for a pretty dangerous variant to be around when we think that we'll see surges because people will be moving back inside again.
That was Dr. Andrew Pekosh there, the Johns Hopkins Bloomberg School of Public Health professor from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Monday morning, the price action looking a little something like this. Unchanged on the S&P and on euro dollar too. S&P 500 futures, Tom, 42.71, pushing 42.72. Euro dollar 119.38, and yields come in a single basis point. TK 151.22.
I'm going to add value here in an important economic week. The VIX with a 14 print a couple days ago, 16.30, shows the reset of a bull market. We're not at 18 right now. I'll get it out. 3, 2, 1. We reset on this horrific pandemic, whether you're in Australia where it's grim, other points grim, John, with the news there on restricted air travel, or maybe in a celebratory America, there is Delta, out of India. Joshua Sharfstein joins us now with Johns Hopkins Bloomberg School of Public Health. Of course, Mr. Bloomberg, owner of this television and radio property as well. Dr. Sharfstein, I want to get to Parent 101. Should we fear the Delta variant?
Absolutely. I mean, given how quickly it is spreading, it should be a concern because it can destabilize even countries that have done a pretty good job vaccinating. So for that reason, I think all these warnings are reasonable, and it's an extra push to get people vaccinated and to help people and others understand the importance of vaccination.
Great. Rah, rah. We're going to do it. Celebrities will step in and say, get vaccinated, et cetera. Or do we need corporations, sporting events, et cetera, to say, enough, you got to be vaccinated if you want to participate?
I imagine that is going to happen, particularly as the vaccines move from the authorization stage to getting licensed. I think it'll become more of a standard in this country, given the very strong safety record that they have and the fact that they'll be fully licensed. I think that probably is going to happen more and more.
Dr. Sharfstein, you said that the Delta variant could destabilize countries, even that have high rates of vaccination among the population. Can you elaborate?
Well, I think countries that have very high rates of vaccination are going to be protected, but countries that have pretty high rates, you can see now even the United Kingdom, the cases going up, and even the sign that deaths may be going up. The United States, where we have states with relatively middling levels of vaccination, we're going to be particularly vulnerable. We'll see meaningful outbreaks, and if not the fall, maybe even this summer in some places, based on just how transmissible this virus is. And, you know, hospitals will start to fill up again.
Well, Dr. Sharfstein, there's a distinction between destabilizing nations that have vaccinated individuals because those vaccinated individuals are getting sick from the Delta variant, as certain news reports out of Israel showed over the weekend, versus just being more prevalent among those who are not vaccinated. I mean, can you give us a sense of the risks on the other side, even for vaccinated individuals?
The risks are much less for vaccinated individuals. So vaccinated individuals can still get sick. They can still get very sick, but it is pretty rare. But, you know, we should care about how the entire state, the entire country is doing. And by that metric, we should all be worried, because it is true that people who are unvaccinated are particularly vulnerable. And, you know, these viruses can cause serious damage even among young people.
Okay, but Dr. Sharfstein, we have this with other illnesses too, and this is where it comes to the threshold of when we start treating COVID like just another virus that we have to deal with, like the flu, like other common colds that people get. There is a question at what point we cross the Rubicon where people have vaccinations available if we're not seeing the high hospitalization rates where it's okay and we can't necessarily just restrict travel and restrict business activity. When do we cross that line?
Well, I think first, from a public health perspective, you have to realize the amount of illness and death that we're potentially vulnerable to, for example, in the United States, is enormous and would swamp normal flu season. So we're not talking about flu in the sense of the number of deaths if we don't get more people vaccinated. So, you know, from a public health perspective, that's one thing. So if, on the other hand, we want to say, okay, from a social perspective, we're willing to say, it's all on you. We're still going to be spending a lot of money for hospitals. It's going to affect how our healthcare system operates. It potentially could make people, even who are vaccinated, afraid to go out and spend money in the economy. So, the fundamental dynamics haven't shifted. We're all better off if we can control the total amount of illness out there.
Joshua, what's so important here is Lisa Abramowicz's kids have already started their reading for fall. I mean, they got a reading list of like 14 books. It's June, and they're already into it as well. Dr. Sharfstein, can you say that our assumed school return is in jeopardy because of the Delta variant?
I think it's premature to say that. I'm curious what age you're talking about for your kids, but for adolescents,
you don't want to know.
Okay. Are particularly now able to get vaccinated. I think that'll be obviously very helpful. We're going to have to see. There's always been a little bit of a question mark with exactly what the virus is going to do, but I do think that in certain areas where the vaccination rates are overall low, we are at risk for serious outbreaks. And in those areas, it may be that different kinds of measures are going to be needed, particularly this fall.
Doctor, always good to catch up, sir. Thank you. Dr. Joshua Sharfstein there, the Johns Hopkins Bloomberg School of Public Health Vice Dean. In many ways, Lisa, the story hasn't changed. Have we cut the link between the cases, which are starting to tick higher in a material way in places like the UK, between those cases and hospitalizations and ultimately deaths?
You are breaking that link when it comes to social behavior. And certainly you're seeing that in New York City as hospitalizations drop to a post-pandemic low in terms of the COVID pandemic. There is a question at what point that takes precedence, the fact that people are behaving as though it's over.
Well, it's not over in Hong Kong. They're banning all passenger flights from the UK from July 1st, and whether you want it to be over or not, these governments are still doing things like this. Sajid Javid's the new health secretary in the UK, Tom. He spoke earlier this morning with Sky News, a broadcaster in the UK, and said, I want to see the restrictions lifted and life going back to normal as quickly as possible. That's a direct quote. And many people anticipating that he's going to be a little bit more liberal than the health secretary that came before him. We'll see.
Yeah, but what are the facts saying? Close, John, I want to go over to Italy, where part of Italy saying, come on down, come visit, and the other part saying we're in lockdown. I'm sorry, I'm confused whether it's Hancock or Javid.
You're not the only one who's confused, and it goes back to what Lisa mentioned earlier on in the previous hour. In the last hour, Lisa, threshold, tolerance levels, they're different country to country, even if the scientists are seeing the same thing.
Well, yeah, and this is one of the reasons why, for example, the European Union is saying U.S. visitors can come over, and they're saying, why won't you reciprocate? The U.S. is just saying we're not gonna.
Haven't figured it out yet. Coming up, David Kotok, Cumberland Advisors CIO, with your equity markets sitting pretty, coming into a brand new week of trading at all-time highs. 42.72 on the S&P 500. Yields down a basis point, pushing 2 basis points lower now, almost. 150.88. Tom Keene, Lisa Abramowicz, Jonathan Ferro. This is Bloomberg Surveillance.
The market just isn't convinced that we've made enough progress yet.
It'll be a busy summer down in D.C., and the bond market, I think, will have to pay attention through the summer.
Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained.
If we do get wage growth, which I think is coming, I think inflation is going to be a problem.
Once you have jacked wages up, then it is very difficult. You almost never see in any country around the world wages begin to go down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Coming into Monday at all-time highs from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. 7 a.m. Eastern Time. Equity futures 42.72 on the S&P 500. Going into Friday, Tom, we know the story. We're so familiar with it. Demand sky high in America. Will supply arrive?
Wicked early jobs day coming up this week, John. It's going to be an eventful week of economic data. And, John, this is the week where we really readjust portfolio views in bonds and equities out another 6 months as well. Every guest is making tweaks, making adjustments. We need to hear from them.
And that estimate's going to move going into Friday over the next several days. At least 700K
Yes.
is the estimate right now.
Yeah, but the upside surprise is really what's expected. And this, to me, is interesting. The consensus is that the economy could run hotter. Is it increasingly the consensus, even after some of the moves that we've seen in treasuries, even after the yield curve has come off some of its steeper levels of the year? And I'm trying to understand this sort of divergence here in views.
John, I'm going to go back to Daniel on in the previous hour. Take his 24-month GDP report. As Lisa says, I'm sorry, BNP Paribas, usually cautious, they're 6% plus growth for 2 solid years.
Deceleration is going to be the key term as we go into the back half of this year, as we close out the front half. Decelerating economic growth. The rate of change is arguably behind us. In the minds of many people, not myself, I don't have a call, of course, but Lisa, the difficulty for a lot of people is that the peak growth, if it's behind you, and that goes into a summer as the Federal Reserve starts to adjust its communication and reduce QE as well, is that an environment where you want to be long risk assets still? Do you want to stick with the trade, stick with the things that worked in the first half, in the back half?
A lot of people say yes, and it's simply because Treasury Treasury yields are so low, and whether it's what Lori Calvasino was saying about the fact that there is a sort of underweight to bonds, so there is a potential for buying going forward. It's a conundrum, though, especially with such real yields that are so negative, as Tom likes to point out, John. There are dissonant messages here, especially if the Fed starts to take the pedal off. And that is really the key question heading into that Jackson Hole summit.
Nominal yields heading south, down by 2 basis points this morning. Let's get to the price action this Monday morning. Equity futures 42.72. Equity futures unchanged on the day. Your yield on a 10-year in almost 2 basis points now, down to about 150.71. Euro dollar unchanged at 119.35, and crude just south of a 74 handle, Lisa, 73.97.
As we were talking about and picking up on yields heading just a bit lower, not that much drama. In fact, nothing going on. There really is a question what the threshold is for Federal Reserve officials to start changing their guidance, especially heading into the Jackson Hole meeting. 9 a.m. we get comments from New York Fed President John Williams. One of the 3 big ones, right? We've learned over the past few weeks there are certain Fed officials you need to pay attention to more than others. John Williams among them. The others is Vice Chair Rich Clarida, as well as, of course, Fed Chair Jay Powell. The key question is how many good data sets do they need heading into jobs report Friday? How many of these upside surprises do they need before they start changing their guidance? Today, also, we're going to be hearing President Biden is meeting with outgoing Israeli President Reuven Rivlin. I want to know what the stance is on the Iranian nuclear accord, especially after those airstrikes on Iranian-backed militias in Iraq and Syria over the weekend, raising questions about the willingness to strike another deal. And, of course, this really affects the oil market because it determines whether the barrels of oil from Iran are brought back online. And today, after market, the biggest U.S. banks will reveal how much money they're going to give to shareholders. The expectation is more than $140 billion for the biggest 6 banks. How much of this, John, is being priced in already? I mean, it seems like every bit of good news has been priced in, which is the reason why you so well put it last week. Have we reached peak everything? And will everything be greeted with a shrug?
And does that include what's happening down in Washington, D.C. as well? Lisa, thank you. Fantastic as always. And Tom, that's where the confusion was going into the weekend. Is there some kind of veto threat in the administration over these 2 bills they're trying to push through? This is what the president said in a statement on Saturday, that his comments, quote, created the impression that I was issuing a veto threat on the very plan I had just agreed to, which was certainly not my intent. Does Speaker Pelosi agree with him?
No. I mean, we heard that from Anne Marie Horton. I mean, it's just that simple. And this is politics, and the Democratic Party has to sort this out. John, one thing I would say, after the quiet of the Clinton years, the quiet of the Obama years, the Democratic Party, many would say, is reverting to what it's always been, which is fractious.
Let's bring in David Kotok, shall we? Cumberland Advisor, CIO. And David, if I may, I want to start right there. Is there still a big bet on something big happening down in Washington?
I don't know about, I mean, it looks like we'll have some type of infrastructure plan, John. They have to deliver a plan. It won't be as big as anticipated, and it will have all kinds of changes in it that's underway. Biden wants to complete something. The Republicans don't want to be the obstacle to nothing. So it would look to me as if something will happen. And whether it's $1 billion or 900 billion or a trillion or whatever the number will be, we're going to find out.
David, I want to talk about markets first. We'll do COVID here in a bit. David, you went to some cash here. Everybody follows your often allocations of ETFs at Cumberland Advisors. You're sitting on cash. What are you going to do with it? What does your research on sectors tell you right now?
Well, our largest sector, Tom, is the healthcare sector. We have maintained that as a strategic position. That group did very well and then sort of leveled off, except for a couple of biotechs. We believe the COVID shock is a strategic shock that will take years. And the healthcare sector in the United States and the various component parts of it are the beneficiaries in a business sense. Wish it were otherwise. We don't want pandemics, but that's what we have. So the healthcare sector is probably 14% of the S&P 500 weight. In our shop, we're closer to double that, around 28%. It's the highest weight for a large sector I have ever been.
So, David, I want to go back to this idea that Tom raised about higher cash allocation. What are you seeing not being fully invested that other people are not?
Well, we had a position, Lisa, in in materials, commodities, 2 ETFs. We sold them, and we are not ready to redeploy that cash. We are not going to put any more into healthcare. So we have to look at the sectors very carefully. As you just said in the beginning, we're slowing from a peak. So if you're going down the highway at 60 miles an hour and you slow to 40 miles an hour, at the time you're slowing, you don't know. It feels the same as if you're going to slow to zero. I don't believe we're going to go to zero, but we are slowing. We cannot maintain this 6%, 7% GDP growth rate in the United States. It's not there to be had. So the slowing is going to reveal something. The second thing that's going to reveal a lot are the earnings reports, which are going to start in the next couple of weeks. We're going to get a handle on earnings capacity in this quarter of such robust recovery.
David, because of time, John, Lisa, and I have like 6 things to talk to you about. I know you're in Breckenridge, where the Blue River moves north to the Colorado. We could do the Western Drought. We'll do that at another time. David Kotok, you were the absolute national leader in Wall Street on the bird virus of years ago. Everybody thought you were nuts. And now in hindsight, you look like an absolute genius. Your thought on how we're going to adapt to COVID, the Delta variant, and how we get out of this pandemic.
I think I'm very pessimistic about it because of the political divide in the United States, Tom. And we see it happening. We see Bloomberg reported 482 counties which have low vaccination rates, and they all have rising Delta rates. Pandemic isn't over. It's going to be over sometime. It'll take a while.
Do you fold that into your investment outlook?
Absolutely. We have 1 million excess deaths. We have 3.5 million long-haul disability, partial or full disability COVID cases, and we have more of it coming. So that's what's happening in the United States, and then it's worldwide. So we don't even fold in the global impact yet, but that's coming too.
What specifically then, David, just quickly, linked to that is in your market call?
Well, I want some cash. I want the healthcare sector. And the second overweight sector, John, is defense, because of what the world looks like. You just reported Iran. You've got airstrikes. I mean, defense is a big issue in the United States. I don't see a defense budget cut or anywhere near any impairment of defense. The United States has a very heavy defense load now in this world.
David, got to leave it there. Smart stuff. Interesting, provocative thoughts. David Kotok there, Cumberland Advisor, CIO. Raise a little bit more cash as we work our way through the summer. The argument there of David Kotok, and not original, Tom. I've heard that from BlackRock and Mr. Rick Reeder as well. Yeah, there are all these tweaks going on right now. It's fascinating. And, John, I'm sorry, we're going to recalibrate after this jobs report. I mean, I've been away. I've been unfocused on economic dynamic of 700,000 non-farm payroll. But the fact is, we had that ginormous surprise. And then we had, and now we have a third data point coming out of ginormous surprise. Well, in many ways, Tom, the debate hasn't changed. Lisa, it still remains the same. Demand's already strong. Will supply meet it? That story is true pretty much every way you look, and it's true of the labour market too. 9 million plus job openings in America. Do people arrive to fill them?
Well, but that's the whole rate of change debate. People might arrive to fill them, but we might have seen in terms of profit margins, in terms of the growth in earnings, we might have seen peak growth. That whole idea that David was talking about, if deceleration isn't going to zero, but that's what gets priced in, and we haven't gotten there. Looking forward to catching up in the next hour with Matt Brill, Invesco, head of US investment grade and senior portfolio manager too. We'll do that in the next hour from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowicz. I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV with your equity market coming into Monday morning, close to all-time highs, 42.73 on the S&P 500. We advance just 2 points this morning, positive 0.04%. Your yields are coming in almost 2 basis points on a 10-year to 150.71 following the sell-off last week, the week before. Then yields come back in, then yields go higher. You get the picture, 150.71 on your 10-year. From New York, it's going to be a hot one. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. U.S. airstrikes on Iranian-backed militias in Syria and Iraq have come at a delicate time, the Pentagon says. The raids were aimed at deterring future attacks on U.S. interests in Iraq. Iran's president-elect Ibrahim Raisi takes office in August. He's been seen as someone who'll take a harder line against the U.S. Meanwhile, talks on reviving Iran's nuclear deal have dragged past initial timetables. 3 Republican senators say President Biden's infrastructure deal is back on track. There was concern the deal could fall apart when the president linked it to a larger tax and spending bill that Republicans opposed, but the president walked back his remarks Saturday. Republican Senator Rob Portman says work on the bipartisan legislation can move forward. The last and only foreign scientist in the Wuhan lab is speaking out to Bloomberg. Danielle Anderson was working at what has become the world's most notorious lab just weeks before the first known cases of COVID emerged in central China. The Australian virologist wonders if she missed something.
There was no chatter of anything. Scientists are gossipy and excited, so yeah, nothing strange from my point of view going on at that point that would make you think, oh, something's going on here.
There's been a lot of speculation that the virus leaked from the Wuhan lab. The U.S. has questioned whether the facility was safe. Starting Thursday, Hong Kong will ban all passenger flights from the UK, and the country will be classified as extremely high risk. There's been a rebound in the number of coronavirus cases in the UK, plus the spread of the highly contagious Delta variant. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I do trust the president, and he made very clear in the much larger statement that came out over the weekend, carefully crafted and thought through piece by piece, that if the infrastructure bill reaches his desk and it comes alone, he will sign it. At the same time, I recognize that he and his Democrat colleagues want more than that.
So I think we're on the same page, finally. That was Senator Mitt Romney there of Utah speaking to CNN from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Monday morning with your equity market at all-time highs. We add another 2 points, almost, to the S&P 500 at 42.73. Outside of that, yields lower by a single basis point to 150.88. And central bank after central bank just coming out this morning and saying the following. This from a member of the governing board over at the S&P, the Swiss National Bank. Easy policy needed, not ready for the exit. This coming from the central bank governor of Austria, Mr. Robert Holzmann, saying the following. We don't know yet if the emergency is over. Emergency is the key word here because they have an asset purchase program with the word emergency in it. The emergency purchase program, the pandemic emergency purchase program, Tom. So if the emergency isn't over, more than a year since the emergency started, it means there will be this renewed, continued commitment to buying bonds at the ECB with a lot of flexibility.
You know, and we'll see John Ford, and, you know, guess what? We're data dependent. Do you agree? I mean, it's really all this has come out to.
Which data? What's the threshold? What's the outcome? If we're outcome dependent at the Federal Reserve, what's the outcome that they're actually looking for? And they haven't described it. And it's clear from policymaker to policymaker, they all have their own version of it.
I would go with that every nation for themselves. I sound like Ian Bremmer, but that's where we are in monetary theory right now. The senator from Utah, we hear Senator Romney over the weekend. What I would focus on right now is the definition of progressive liberal. Lisa Lair with a wonderful article in the New York Times over the weekend, maybe it was Friday, on progressives in New York City. Emily Wilkins looks at the national view from Washington. Emily, how lonely are liberals, are progressives right now? What's their percentage effect in Washington?
Well, it seemed like on Friday that progressives were doing quite well. They had been asking for weeks for a guarantee that the larger Democratic-backed reconciliation bill, the thing that would have child care, health care expansion, climate change, that would move with any bipartisan infrastructure plan. And you heard House Speaker Nancy Pelosi say, absolutely, we're going to move it like that. You heard Biden, but then you saw Biden go ahead and walk it back. And I think there's a big question now, how do you keep progressives on board, but also make sure you've got your Joe Manchins and your Kirsten Sinema's and your more moderate Democrats on board?
All of our experiences, you can't do that. And my question is, Emily, is okay, they can make a lot of noise, that's fine, but are they like are they like under 20% of Washington, or are they more dominant than that as we try to get an infrastructure bill done?
I mean, look, the progressives who might be willing to buck this, who we've seen buck other Democratic-backed bills, yeah, they're a really small percentage of the Democrats who are there. But the thing is, they don't need to be a large percentage. I mean, you lose one senator in the Senate, you lose 4 members in the House, and Democrats can't get what they want through. And so if there are going to be progressive members who say, look, we're just not going to vote for this bipartisan infrastructure plan until we see reconciliation come and we can vote on that, that's going to be enough to hold up the process. The question is, will they do it? Because traditionally, progressives, as most Democrats, they want to get something done. They don't want to go home to their districts empty-handed. And so it's a bit of a careful debate. You know, do you want to deliver the biggest package possible, or are you going to be okay with simply delivering a smaller package that you know that a Joe Manchin can go for?
Emily, that's exactly where I wanted to go. Heading into the 2022 midterms, as Democrats do campaign, what is the least worst outcome for them at this point, given some of the pushback to the bipartisan agreement, the $579 billion plan? How left has the Democratic Party gone that not getting anything else done would become a liability?
I mean, Democrats, and this is true of moderate Democrats I've talked to, this is true of progressive Democrats I've talked to, they all realize that things would be very, very bad if they got absolutely nothing done. They need to get something done. It's just the fact that moderate Democrats are a little more comfortable getting, say, just the bipartisan infrastructure plan done. But look, now you've even heard Joe Manchin come out and say, yeah, I'm cool going for a Democratic-backed, more expansive reconciliation package. And then comes the question, well, how big is it? Manchin's talking about $2 trillion. Bernie Sanders talking about $6 trillion. And this is a negotiation that's going to go on over the next couple weeks as they try to write out the details of this bill and start to see where the devil in the details are.
Well, and the fact that Bernie Sanders is crafting it means the process might be a little longer, no? I mean, because it has to get down to the middle. Is there any chance that we could see these two bills actually presented in tandem?
It'll be interesting to see exactly what Speaker Nancy Pelosi does with these bills, because if she gets the sense from the progressives within her caucus that they're not going to vote on that bipartisan infrastructure bill alone, then she's going to have to wait for a reconciliation bill to come. And she's been very adamant on that particular point. And you look at the chamber, you look at the dynamics of her chamber, she only needs Democrats to pass bills. It's not like the Senate, where you see sort of President Biden a little more focused on right now, where you do need those Republican votes. Pelosi knows that all she has to do is keep her caucus together, and she'll be able to move things forward. So we might wind up seeing those bills go ahead and move in tandem if Pelosi chooses to hold up a bipartisan infrastructure bill until that broader Democratic reconciliation is able to come to the House floor.
So, Emily, just quickly, how much daylight is there between the Speaker right now and the President of the United States?
I think to a certain extent, they both want to get something done. It's just a method of how they do that. And it's a matter of the votes. If Pelosi has the votes to go ahead and move that bipartisan infrastructure plan to the president's desk, she may well do that. But if you don't have the votes, you can't move anything until you've got them. So I think at this point, the question is, how much muscle are progressives going to show moving forward here? Are they actually going to block a bipartisan infrastructure plan, knowing that many of their districts could benefit from it, to hold out for a larger, more expansive bill?
Emily Wilkins down in Washington, our Bloomberg government reporter. Right. Emily, thank you. Always fantastic. Lisa and I were talking about this at the back end last week as you were on the beach eating lobster rolls or something, Tom.
John, there's
150,
no beaches in Maine.
71.
$40
goes in
lobster
a couple of basis points. What is it? A port?
No,
some boats? What is it? No, just rocks. Can you not have a beach that's made up of rocks?
No.
No? It's got to have sand.
The water's so damn cold.
Your definition of a beach has to have sand.
The American definition.
The American, or is it the Tom Keene definition? Okay, let's move on from that.
Let's move on.
I don't want to get bogged down in that.
John,
anyway.
can I give you a good research
is,
piece?
Please do.
Okay, Morgan Stanley, Michael Wilson, over the weekend with a research piece of the weekend. John, inflation-adjusted minimum wage is near decade lows, even with the worries of rising wage growth. I thought the MS work was just brilliant.
And it's been brilliant over the last couple of months, Lisa, too.
And there's a question, though, of whether they'll actually rise. And if they do rise, whether this will be good for the real economy and bad for markets because it shrinks margins. I mean, this is sort of going to this debate that we see in the second half of the year.
You know, John, if I hadn't met on the beach in Maine, I would have written this up on Friday or Saturday. I failed. I'm sorry.
Well, the point I was trying to make is that on Friday. We didn't get a massive move in 10-year yields, even though we did get what seemed to be a deal down in Washington, D.C. Your bond market, 150.71.
I could see John up at Millinocket, like heading up Mount Katahdin. I mean, come on.
Are you speaking English?
John,
do you
on the
understand
knife.
any of that?
Nope.
But yeah, sure, I could see it.
30-mile hike.
I can see it too. Welcome back, Tom. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Equities up 4. We advance 0.1% on radio, on TV. This is Bloomberg. 2 hours away from the opening bell in New York City this morning. Good morning. Live on TV and radio, here's the price action. Coming into Monday, record highs after the biggest weekly gain since February, adding about 2.74% to the S&P 500. 42.74 is where we are right now, advancing almost 0.1%. On a NASDAQ, advancing 42 points, up by about 1/3% on the NASDAQ 100. A little bit later after the close today, Lisa mentioned it in the previous hour, look out for the banks. You could get an avalanche of announcements. Six of the biggest banks in America set to announce something close to $140 billion in capital returns.
John, I don't mean to stop this, but this is important. Is this a coordinated announcement by the banks? Why is that?
Well, it's not coordinated per se. They had to wait until after the close on June 28th to make the announcements after getting the green light from the bank stress test last week when you were eating lobster, Tom Keene. Year to date, the banks on the S&P 500 up by 28.74%. To add to that, do capital returns get it done alone, or do you need the bond market to come with you? So let's turn to the bond market. 2s, 10s, 30s on a Treasury curve. Yields at the front end, almost 26 basis points at 0.2582%. And on the 10-year, this is where we've just had a total round trip. Going into that Fed decision that morning, south of 150, just south of 150. Then we were higher, then we were aggressively lower. We saw 135 last Monday, this time last week, and now we're back to 151. If you want that bank's trade to perform, do you need more than just capital returns? Do you need that bond market to come with you? High yields, a steeper curve. Want to watch a little bit later after the close then. Driving you into the close, Romain Bostic. Hey, Romain.
Hey, good morning, John. Good morning, Tom and Lisa. Keep an eye right now on shares of Boeing. Those shares slightly weaker here in the pre-market. Some concern here about the latest edition of its 777. Keep in mind, this is that long-haul version. It's a little bit similar to the 737 MAX, and the concern here is that the FAA has actually said that there might be some issues that Boeing needs to address with regards to the so-called uncommanded pitch error. Remember, this is the same type of error that was linked to the fatal crashes of the 737 MAX. Something to keep an eye on. It could delay certification of this plane until at least mid-2023, maybe even later. Also in the aerospace sector, keep an eye on Virgin Galactic rallying here for a second day, of course, after receiving FAA certification to begin those space flights. And then in the chip space, NVIDIA higher as well. This after the company getting a little bit of a boost here from some of its customers with regards to its acquisition of ARM. That's the UK semiconductor group. Those customers basically saying they're not worried about the antitrust concerns. The UK, EU, China, and the US still reviewing that deal. All right, flip up the board. I want to bring you just a quick check here on what's going on in the biotech space. We got some interesting news out of Intellia. Of course, this is a company working on that CRISPR technology. As a gene editing technology, they're specifically focusing on a genetic liver disease. The results from that came back pretty good. This is an early clinical study, but it's the first major clinical study in the human body of this technology. This is a big deal here. You're seeing Intellia rally more than 50% here in the pre-market. A lot of its competitors in this space, like CRISPR Therapeutics, Editas, Beam Therapeutics, also rising here this morning, as is Kathy Woods' innovation ETFs, as well as his ARC Genomic ETF, those shares, those ETF, I should say, up about 3.6% here in the pre-market.
Romain, thanks so much. Let's get right to it here on the outlook forward. And James Athey joins us now with a really smart research note updating the view at 6/30/2021. He's with Aberdeen Standard this morning. James, I'm not going to mince words. You look for a second half that is flat out, quote, more difficult. Why?
Yeah, I think some of the tailwinds which have been, helping us see some of these incredible growth inflation numbers, and certainly have been helping to keep market sentiment as buoyant, if not euphoric, as it has been. I think many of those will be turning to headwinds. Some of them already have. So We already know that China policy mix is shifting, has shifted. I think once we get past the CCP anniversary in the next few days, I think we should expect to see that continue to tighten. And then just in terms of rates of change and deltas, I think we've probably seen the best of it for US growth, and we've probably seen the best of it for US growth expectations. And I think fiscal policy, we're still talking about infrastructure packages, but the magnitude is just minuscule relative to what's in the rearview mirror. So from an impulse perspective, I think fiscal policy will increasingly be a headwind.
We caught up with David Kotok of Cumberland Advisors a little bit earlier this morning, James, and he was talking about a car decelerating from 60 mile an hour to 40. Truth of the matter is, if that's the example, you're still heading forward, still moving forward. Is that not an environment you want to own the equity market in anyway?
Why do you ask me that question, right? I'm a bond guy. I don't understand the equity market at the best of times. Apparently, you want to own the equity market in every environment. There's a very simple algorithm which you can run, which is if the economy is doing well, you own equities. If the economy is doing badly, then the central bank will buy stuff and you want to own equities. In that very simple formulation, I can't think of a world where you don't want to own equities. Unfortunately, valuation never seems to come into that argument. So I'm just going to lean on the fact that equities are expensive and are expensive because of stimulus more than they are because of growth. And so I think the delta in stimulus is more important than the fact that growth is positive, certainly not if the rate of change in growth is slowing.
Well, James, I was taking you down equity lane so I could then take you back over to the credit market. If valuations don't count in the stock market, do they count in credit at the moment? When we just saw high-yield debt issued last week from Centene with a yield of 2.45, does anything matter in that environment?
Doesn't seem to, does it? It doesn't until it does. That's not new news for financial markets. Glib aphorisms, which by definition contain some nugget of truth and insight in them. Things like price is what you pay, value is what you get. In the short term, value doesn't matter. In the long term, it's all that matters. I think they're quite apt in this environment. If the risk-free rate is zero, and the Fed is forcing, and central banks in general are forcing liquidity into the system, we shouldn't be too surprised that asset valuations can become stretched. The question is sustainability. It's a word I don't hear much of in the conversation, but to me, what matters is the sustainability of anything which is acting on asset prices. And I just don't see the inflation we're seeing, the growth we're seeing, and the policy stance that we're seeing today as being sustainable. And in that respect, I think the future doesn't look quite as bright as the recent past.
James, I want to go philosophical here because we're raising a question of what can act as a canary in the coal mine. If it's not treasury yields, if it's not German Bund yields based on what central banks are doing, if it's not high-yield bond spreads, which are at post-credit crisis lows, if you talk about a 2.5% yield on a new junk bond being issued, what's the new canary in the coal mine? What signals in the market can you depend on?
I have to say, I think it's probably the old canaries in the coal mine, Lisa. You're right. I mean, the credit market, there is the fear of missing out in risk markets in general is a huge psychological driver of investor behavior. In credit markets and in high yield markets where liquidity in the secondary is so bad, the fear of selling out of an asset you can't get back into is equally dominant. And so they are lagging indicators, essentially. Once we know things have gone bad, credit spreads will have already blown up by that point, and people will still be holding those babies. So I don't think we can look there. In equity markets, the dominant psychology because of 10, 12, 20, pick a number, years of central bank monetary largesse also means that dips are bought aggressively, systems are in charge rather than value investors. The treasury market, the dollar, to some degree commodity markets, I think they're more likely to be an earlier indication that things aren't right. And in that basis, you look at the fall in break-evens, you look at the fall in five-year rates, you look at the flattening of the yield curve, the rise in two-year yields. To me, all of these are indications of what potentially is to come.
So what's the safe asset to hold? I mean, does it just go to cash at this point if you are concerned or you do see in those tea leaves some signs of caution?
Well, I mean, if you have my view, and that is that the second half of the year is more difficult, but we're likely to still see elevated inflation, that monetary policy is on a path towards a tighter stance. That path could take a while, but certainly, again, the change is towards tighter policy, similarly with fiscal policy, then ultimately duration has value, particularly at the long end of the yield curve. I don't think potential GDP growth in the US is higher today than it was pre-pandemic. I'd argue it's lower. And those very long tenors in the yield curve really are there to try and target, the structural rate of growth, the structural rates of inflation. So I think there's value there, but I think there are risks that the market will continue to be nervous about Fed hikes, Fed tapering, Fed tightening in the intervening months, and therefore short-dated yields at 25 basis points don't look particularly attractive. So long the long end in flatteners, long the US dollar, because the dollar will work if the Fed is hiking. It will also work if you have a big risk-off period. That's how I am positioned. That's how I would be positioned, yeah.
The British weather seems to be affecting your portfolio management. Maybe just a little bit, James. If the sun came out, would you change, James Athey? Aberdeen Standard Investment Senior.
John, so we don't have to worry about that.
Our Senior Investment Manager over Aberdeen. James is going to catch up, sir. Thank you very much. Margaret Town of Wells Fargo was on Real Yield with me on Friday, and we were going through some of these credit dynamics, Lisa, and she just turned around and said, we're stripping cyclicality out of the credit market. That's what the Federal Reserve has tried to do. They've achieved it. We need to stop talking about the cycle and what it means for credit, because it's not going to pick up on any of it.
Well, the idea here is there is the ultimate backing. If central banks are going to swoop in at any kind of macro disruption, then why not go all in, even if you're not getting that big of a return? And that really has been the issue for the likes of Howard Marks, even, who really founded this market.
Two headlines that have come out in the last hour, one in the last couple of minutes. Let me first go to the one that came out about 45 minutes ago. Came from Hong Kong to classify the UK as extremely high risk, to ban all passenger flights from the UK as of July 1st, which is Thursday. And then Boris Johnson, the British Prime Minister, comes out and says lifting COVID curbs is very likely on July 19th. Now, Tom, not for me, of course, to take a view on any of this whatsoever.
No, we wouldn't want that.
But just in terms of how things are lining up here, July 19th feels like a little long way away.
Yeah, that's
from where we are right now.
I don't understand. I mean, I don't get the whole Hancock Javid thing and the rest of it.
We won't go there, Tom. Let's save that.
Okay, but John, seriously, it just seems out of kilter. Do you feel that way?
It feels that way given where cases are going. Now, between now and July 19th, I think we have a really, really important case study, Lisa. Deaths have remained low. Hospitalizations have remained low in the UK. They've just started to tick a little bit higher, but certainly nothing like the magnitude. The cases have moved higher. So what does that look like from here out to July 19th?
I also think that there's a recent history bias. Remember when COVID was starting to circulate and people took a while to put masks in implementation and certain policies, and then things got worse. They want to avoid that this time around. But how long's too long?
TK, yeah.
I'm not focused. I'm waiting to find out what you think on England, Germany. To me, it's like, you know.
That's the big one tomorrow, Tom.
Tomorrow. It's bigger than France, Switzerland,
Did you watch Italy on Saturday?
I noticed Italy doing very well.
Very stressful. Very
stressful. I was at Luke's Lobster in Portland. We watched Italy.
Burning a hole in your pocket, apparently. Yeah. 42.74 on the S&P 500, inching higher by almost 1/10% from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The U.S. has launched airstrikes on Iranian-backed militia groups in Iraq and Syria. The Pentagon says that's to deter future attacks on U.S. interests in Iraq. Those attacks could be an early test for Iran's President-elect Ibrahim Raisi. He's been seen as someone who'll take a harder line against the U.S. than departing President Hassan Rouhani. In South Florida, rescue workers are digging for a fifth day in the rubble of a collapsed condo building. They say they could still find survivors. 9 people are confirmed dead and more than 150 are still missing. The last live person was rescued Thursday, hours after the collapse. The U.S. labor market is entering one of its strangest summers ever. A powerful economic recovery is generating record demand for workers. Still, millions of Americans remain reluctant or unable to go back to work. For some, a temporarily strengthened unemployment insurance safety net has reduced the need to get a job. Others have childcare issues or are concerned about the coronavirus. Blackstone is increasing its bet on logistics. Bloomberg has learned that the New York-based private equity group has agreed to buy the warehouse properties of British grocer Asda for about $2.4 billion. Asda will rent the 25 warehouses after the sale. And the CEO of Burberry is stepping down to take up the top job at Italy's Ferragamo. Marco Gabbetti is moving from a luxury brand in the middle of a turnaround to another that wants to start one. Gabbetti has run Burberry for almost 5 years. He revamped the trench coat maker's product line in an attempt to make the brand even more upscale. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The trend is shifting from goods being a key driver to now moving towards services being a key driver. Over the next several months, we need to monitor very carefully whether the services component, in other words, the reopening parts of the economy, continue to see high inflation. There are good reasons to be very cautious here in terms of the outlook.
Good to catch up with Torsten Slok, the Apollo Global Management Chief Economist from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's the equity market this Monday morning, 42.73 on the S&P, climbing just 2 points, up by 0.05%. Outside of that, yields coming in almost 2 basis points, 150.71. Euro-dollar, euro now negative by 0.2%. Euro-dollar just about clinging on to a 119 handle, 119.08. That's the price action. Did you guys see UBS, the reporting that we've done on UBS recently in the last 24 hours? They will look to allow 2/3 of employees to adopt a hybrid work effort. What's interesting about this is that they see that as potentially competition with the American banks, Tom, to attract talent.
Are they okay? Great. Are they going to do it in America, or is it going to partition over to the continent?
I believe so, for UBS specifically. And Lisa, what's going to be interesting about this, if you work at, say, Morgan Stanley or JP Morgan or Goldman Sachs, and they're saying get back to work, and you don't quite fancy the idea of 5 days in the office in New York City, there might be an alternative available to you.
Yeah, and this is actually being used as a recruitment tactic, right, by the likes of UBS and actually Deutsche Bank, taking somewhat of a similar tact. Again, though, I'm wondering what a partial or at least hybrid model looks like. Is it 1 day a week that you can work from home? I mean, how much do the nuances play in here versus a 5 days a week, but still that split being highlighted to be borne out, though.
And it won't be for everyone. Let's be clear about that. According to our reporting, at least, Tom, it won't be for everyone. For instance, for example, if you're a trader, I imagine you're expected to be in the office 5 days a week.
Well, we'll have to see. I mean, over the weekend, John, up Route 1, up Maine, up the coast, and then you say, how far to Canada? John, 4 hours. Did you drive? You're like barely in.
Did you drive?
Yeah, we took the Nash. It was great. No, you go up, and it's like Canada, it's 4 hours away. Dave Wilson goes all Canada today with the Montreal Canadiens tonight playing for the Stanley Cup. What do you got?
Well, what I've got is Bank of America basically saying, you know, you got to take a look at Canadian stocks relative to U.S. shares when you compare valuations. Now, what they did was look at forward price earnings ratios on the S&P TSX Composite and the S&P 500. And, you know, you're talking about the Canadian index being 23% cheaper as of Friday. You only have to go back a couple of months. You see that discount was 27%.
What's a catalyst that moves that? Is it loony?
Well, you know, to some extent, perhaps, but, you know, think about earnings. I mean, you're talking about a stock market that has much more sort of tied into energy and metals. I mean, talk about a couple of areas that have benefited along with the economy, you know, and so that's part of Bank of America's argument. It isn't just about valuation. It's just, you know, in the Canadian market, if you do get this global economic recovery, you stand to benefit more by being in Canadian shares than you do in U.S. shares. So, you know, they're looking at it in terms of where the market is as opposed to just valuation.
And Dave, on a broader sense, does this mean that at least the sell-side analysts see the balance of complacency as not necessarily being complacent enough, that basically people haven't bought into the reflation trade enough and need to double down, and this is basically one way to express it, given the fact that Canada has been way behind the U.S. and other nations when it comes to vaccinations?
Well, that may well be part of the argument here. I mean, you have to note that the S&P TSX has done better than the S&P 500 so far this year, at least. But, you know, at the same time, you've seen its valuation sort of move into line with global markets when you look outside the U.S. and focused on developed countries. So, you know, you put that all together, it's not like you're necessarily paying up at the same time that, you know, you're looking at a market that stands to benefit more than others, you know, perhaps the U.S. for sure, when it comes to economic growth.
David, I mean, I know we don't have the photo, but I mean, Celine Dion singing the national anthem in a Vegas hockey jersey, that's un-Canadian.
You know,
I'm sorry,
Dave. You don't have to respond.
I'll accept your argument, Tom. I have nothing to kind of come back with here.
I'm up in Maine, John, and Tobias Lefkovich is emailing me about Celine wearing the Las Vegas garb. That's like, John.
When do we hear the end of your trip to Maine?
Next
How
year.
many days were you there for?
I was there for 12 hours.
I've not been out of the house for 2 years. It's almost as if TK's not been out of the house for like 2 years, made it to Maine for 24 hours, and
yeah, it's like going below 59th
this is it.
Street.
Breakthrough. I left the house. How did it go? Who did you go with? Why did you go?
No, we just went, you know.
You just went.
Okay,
Okay.
my
went
favorite.
for the winting of it.
My favorite is that Al from New Jersey is doing research into the price of lobster rolls to make sure he doesn't
No,
have to
it's
give you a
nationwide.
raise just to pay $40 lobster rolls and cover all
Lisa,
the ones that you did.
did you know he expenses his vacations?
You expense the lobster rolls?
Totally busted.
absolutely.
I know he does this.
Yeah, you know, I mean, I think we should do a road trip, Booth Bay Harbor. We should do the show from there.
Yeah, that'll be
You know,
fun.
I see it, you know, in
Okay.
September. John, Ibrahim Rabari, Citigroup, I thought with an important research and controversial research note here. What if we get a good jobs number? What if we get a bad jobs number? And frankly, it folds into the key question, is the taper dynamic.
And how does the price respond to that data, given what you just said? Is the good news going to be bad news, Lisa?
I don't know.
Well, honestly, good news is going to be bad news if you can trust what the notes say. At least certainly Morgan Stanley's Vishy Terpatur putting something out and saying that actually good news could make the Fed more hawkish and that this will be more negative. I will just say there seems to be a divergence where the balance of risks for markets is higher inflation and a faster pace potentially of tightening. And the balance of risks for the Fed, John, increasingly stagflation, lowflation, et cetera. The balance seems to automatically shift that way. And I wonder when this sort of gets evened out, what will be the breaking point?
No, you know what I think is absolutely crazy? How finely balanced the difference is between a Federal Reserve that's not done enough and left it too late and a Federal Reserve that's about to choke off growth and end the game. Seemingly just on a data point, on a single piece of communication, we can jump from one extreme to the other in this market, Tom.
And John, what I'm going to say is we still see the grind of the market must react to that dialogue, and we'll see it, I believe, Williams speaking today as well. John, the NASDAQ 100 is ground ever so slightly higher this morning, where the bid is just there because you got to be in the game if you believe in Chairman Powell.
Up a third of 1%. I would say, though, Tom, for the NASDAQ specifically, if you believe that the Federal Reserve is going to start choking off growth equities, Lisa, start to look a little bit better.
Yeah, this is the interesting thing, and this is to exactly your point, John. I'm just looking at this Vishy Terpatur Morgan Stanley report out over the weekend, where he basically said that because of this narrow difference between either the Fed acting too soon or acting too late, they think that any data point could have that much bigger of an impact on markets, and that actually everything's magnified. Stronger economic data could intensify the hawkish tilt, so buckle up. But could it? I mean, that's the thing, because we did not see that with respect to last week's comments. With the hawkish tilt, it led to a flatter yield curve, which pushes the Fed to be more dovish. I mean, it's sort of this enough to make your head spin.
Stay tight.
Exactly.
Tight. Right now, dollar's rolled over, or rather the euro has. Euro weaker. Euro dollar down to 119.06. We're off by about 1/4% on that currency pair. No idea why. Euro slightly negative. Euro dollar 119.05. Down about 1/4%. Outside of that, in your equity market,
John,
up 2 on the S&P. Let me just finish my sentence.
Please, John.
42.73.
I'm getting emails from Booth Bay Harbor. Good morning up in Booth Bay Harbor.
Are they
for the
offering a discount?
Windjammer.
Are they offering a discount for the next trip?
Gerard Cassidy's up there with his 142-foot yacht.
Are you doing secret shout-outs? Is that what this is about this morning?
Yeah.
If you've got to pay the bill.
He's got a helicopter on the backside.
The bill hasn't been paid in Maine. From New York City, this is Bloomberg.
The market just isn't convinced that we've made enough progress yet.
It'll be a busy summer down in D.C., and the bond market, I think, will have to pay attention through the summer.
Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained.
If we do get wage growth, which I think is coming, I think inflation is going to be a problem.
Once you have jacked wages up, then it is very difficult. You almost never see in any country around the world wages begin to go down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. This is an important week, the end of the second quarter. This is an important week, wicked early jobs report. And, John, some Fed speak to get us through it all.
Yeah, and I think we've reset on the Fed side of things. This market much more positioned in line with the core of the Fed. Not much is going to happen anytime soon. You just wonder how much the data changes things this Friday, Tom. The median estimate, 700K.
I'm going to go to David Kotak, leading with healthcare. He's dominant there. He's got cash on the sidelines. But, John, we're seeing all these tweaks. What's your consensus on what the mid-course correction is in this 2021?
The consensus belief seems to be that the peak rate of change, peak growth is behind us, and that going forward from here, things get more difficult because you'll also accommodate that with a lack of accommodation coming from the Federal Reserve, or at least a diminished accommodation coming from the Federal Reserve. Tom, I don't know. What I do know, looking at the last cycle, is that things started to get really difficult when the balance sheet at the Federal Reserve started to be reduced and interest rates started to go through what many people perceive to be neutral. Fact of the matter is we're nowhere near that, and the Federal Reserve is going to have a balance sheet north of $8 trillion, maybe close to 9, and it's going to stay that way for a long, long time. And that stock effect for this market, credit, equities, is going to be really powerful.
It's good. Well, the stock effect can be economics, or it can be the stock effect, which is the Dow. We've got record highs in the last number of hours on SPX and NASDAQ as well. We're going to do a data check in a moment, but Lisa, I want to set up Matt Brill here and do it with the theme for me in this first interview, because Brill was so good last time. And Lisa, it's the tights that we are right now. The yields are unimaginable in the bond market, aren't they?
The idea here that companies are willing to lend to corporations at near record low rates, even above Treasury yields, basically saying we will go anywhere for yields. And it goes to this idea that John was talking about how perhaps these tight credit spreads have gotten divorced from the normal credit cycle because of the Fed's backing, because of the fact that, yes, we had this exogenous shock, and then so much stimulus was pumped into the market. And yes, perhaps we're entering a tightening cycle, but it's really going to be slow.
For all of you on Global Wall Street, Matt Brill was phenomenal the last time he was on the show. We're going to do that here in a number of seconds. John Ferro, I'm looking at the Dow red on the screen, but everything else screams green. Even the VIX in under 16.
I was just looking for the Dow, and I don't see the Dow anywhere.
You don't
I see
have the Dow. You know, I know you don't even have it on your screen.
Look, 42.72.
Oh, there, you're very good. On radio, there we didn't see the number, but we see the name.
42.72 on the S&P 500.
Very nice.
Year-end median forecast in our survey, 4,300. Top end, Credit Suisse, Jonathan Gollard, 46. And at the bottom end, Bank of America, Savita Subramaniam, and I think she has some company down there too, at 3,800. But for the median, Tom, we're basically there right now, just short of 4,300 in the middle of the year.
First thing I looked at when I walked in this morning, besides the price of lobster in Maine, I looked at where we are 6 months trailing on equities. You know what, John? All this worry, angst, go to cash. I'm in the triple leverage cash fund. It's terrible. John, we're up 14%. Focus.
We're up more than that if you look at the banks, close to 30%. Yes. We're up more than that if you look at the energy players, north of 40%. Tom, the debate that we started the year with, on the cyclicals, over the big tech players, growth equities, that's still the debate right now. Middle of the year.
Is the debate.
What do you want to own?
Let's take one data point, John, because FX is asleep this morning. Brent crude, 76 a barrel. I mean, I'm going to go back to Francisco Blanche, $100 a barrel.
You're going with that call?
No, I'm not going with it. I'm just saying we're grinding up.
I just wanted to clean it up, Tom, just to be clear.
We're grinding up.
73.96 on WTI. Slightly negative. I'm with you, though. That's one part of the commodity market that has remained pretty resilient, given the run-up that we saw elsewhere in lumber. Take your pick in soft commodities.
Our guests come on radio and television. They speak to us, and then they make us pause. The last time Matt Brill was on with Invesco, he stopped us in our tracks on the dynamics of supply and demand in the bond market. Lisa, I'm going to have you ask the first question to Mr. Brill, but it's got to be on the supply or the so-called dearth of it coming up.
Well, the idea here being that our company is actually deleveraging. Are they actually becoming more creditworthy and perhaps justifying the tightening in spreads? Matt Brill of Invesco, head of U.S. investment grade and senior portfolio manager, do you think that that's what's going on here, that they're actually becoming more creditworthy companies?
Hey, good morning, everybody. Yeah, I do think that you're seeing just the fundamentals get better and better with the U.S. economy, but you're also seeing corporations really try to figure out how to get rid of last year's debt. And last year's debt was all about survival. And this year, they're really kind of pivoted. And so we've seen AT&T, we've seen GE, UPS are all big names looking to pay down debt. So overall, that's pretty good for the market. I would say valuations are very, very challenged, though. But the fundamentals are going to keep getting better here.
What does the maturity profile of these massive companies look like now, Matt?
So most of these companies have actually termed out their debt. We call this, kind of kicking the can down the road, or really just making sure they don't have any near-term debt maturity. So the average duration of the U.S. corporate market continues to get longer. That's bad from a mark-to-market standpoint. That's because it means there's more duration, more volatility potentially. But it's very good from a fundamental standpoint because it means they don't have near-term debt maturities that they have to worry about if the market were to seize up again. So all in, I'd say that's a net positive.
Does this play into this theme if the same is true of high yield, that we're stripping out the cyclicality from this market, just how sensitive these markets are to a given turn in the economy?
I think so from the terming out of maturities, but also, as Lisa was mentioning, was just the Federal Reserve. And the Fed didn't really buy high yield. They did buy some crossover names. Really just the fact that the Fed was there, I think, eliminated tail risk to the corporate credit market. And so whether or not this will be permanent is certainly up for debate. But we do believe that from an overall beta standpoint, it means that you're more comfortable investing in the investment grade market and a little bit in the high yield market as well.
Matt Brill, I look at all this and I go, is this 2006? Is this 2006?
It's not. It's 2021, just to be clear. But it has some resemblances to it, but not really. So 2006, 2007, you had the TXU LBO. Just a few weeks ago, you had the Medline LBO. The Medline LBO, it has about 50% equity. So TXU, I can't remember the exact number, but it was around 15% equity. So you went from 15 to 50. So there's a lot more equity. Private equity is having to put up more equity into the deals to get these deals done. They don't want to go through TXU. TXU they made some money off of, but at the end of the day, the market wouldn't fund a deal like that today. I really don't think they would. They did, however, fund a $500 million MicroStrategy deal to buy Bitcoin. So, maybe that's a little different. I'd like to say, though, that there is a lot more prudency in this market. There are people that are really not going to make dumb decisions, I don't think, on the investor side of things. But they are being forced to invest, and they are being forced to invest at rich valuations, but not into bad companies, just necessarily maybe not as much yield as they would like.
So where's the opportunity? I mean, I know we're 60-40 in my portfolio. John's portfolio, is 98.2. If I got 2% in fixed income, what do I do?
Well, John's a really young guy, so he doesn't really need a lot of fixed income in his portfolio.
That's good. Al, do something about this kid. Never again. Al, do something.
There is opportunity still in the reopening trade. We're seeing names like Boeing today get a large deal from United. They have some negative news out as well. But for the most part, the reopening trade lives on. The reflation trade, you're calling, well, maybe not calling for $100 there, Tom, but we do think that commodity prices go higher. And with that, there are certainly opportunities with the emerging market world as well. So emerging markets that have more correlation to commodity prices and to asset prices overall going up, we think is good. So there are ways to make money in the corporate market right now, particularly in investment grade around the globe. But it's a lot more selective, and it's not the 2020 trade of just riding the beta. You have to really look under every stone to find value out there.
It's interesting. There's sort of contradictory messages here. On one hand, you have to look under every stone and be idiosyncratic and select securities. On the other hand, it's a macro trade. At a certain point, credit trades in tandem with treasuries, period, full stop, because ultimately it's whether the Fed comes in and backs things and how duration sensitive some of these bonds have become, no?
Yes, that's right. And so duration has really been the key theme of the year. And you look up and we don't have equity-like returns this year, but if you look at most corporate bonds, they're essentially flat on the year in terms of total return. So it hasn't been the disaster that many might have predicted at the start of the year when we were seeing interest rates go higher. So I would say if the all eyes are on the Fed in terms of tapering, all eyes are on the Fed in terms of whether they're going to have liftoff. The foreigners continue to buy a lot of bonds, and if the Fed does lift off, that makes hedging costs go higher. If hedging costs go higher, the foreign buyers will buy less. So to us, that's really the key thing to watch is when will the Fed hike? Because when they do, that will likely make it more expensive for foreigner buyers and less attractive to them to buy our higher yielding bonds here versus their negative yielding bonds back home.
Really smart final point there, Matt. It's good to catch up. Matt Brill, Invesco head of U.S. Investment Grade, is welcome back anytime. Let's pick up on that line.
Thank you.
Let me just pick up on that line, that question you asked, Tom. is it 2006? Well, it's not, because what followed 06 was 07 and 08, to state the obvious. And what I mean by that is this Federal Reserve is just so different, Lisa. This Federal Reserve is hell-bent on not allowing a bust take place in credit.
There is an argument they cannot allow there to be a credit bust because it would torpedo the economy in a way that would be very hard to recover from without a fiscal support that is unreliable, as we have seen even with a crisis. And I say that because the more debt that gets built up on corporate and government balance sheets, the more fraught it is for any interest rate rise that is substantial.
This is the cycle over and over again on repeat. Just to repeat what Lisa said, every single cycle, any kind of downturn, is led and matched by even more debt. And every time we add more debt, our sensitivity to higher interest rates is that much higher, which means that we can't raise interest rates like we did in the previous cycle. So every peak in the Fed funds rate is lower. And what happens on 10-year Treasury yields? Fill in the gap. Pretty obvious, TK. Every single time we repeat this.
And it's Monday.
What does that mean?
The 7th season of Love Island. We got the Stanley Cup
I know. Do you see that?
And Love Island
Can you watch that on Hulu?
He's watching it right
Laura
now.
Whitmore, she's going to kill it. I mean,
have you gone through the new lineup?
Should we do a show from Mallorca?
Would you like to do an interview following her exit? Summer's going to be interesting. It's heating up in New York City. It's going to be a steamy
Mallorca.
42.72 on the S&P. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. U.S. airstrikes on Iranian-backed militias in Syria and Iraq have come at a delicate time. The Pentagon says the raids were aimed at deterring future attacks on U.S. interests in Iraq. Iran's president-elect Ibrahim Raisi takes office in August. He's been seen as someone who will take a harder line against the U.S. Meanwhile, talks on reviving Iran's nuclear deal have dragged past initial timetables. 3 Republican senators say President Biden's infrastructure deal is back on track. There was concern the deal could fall apart when the president linked it to a larger tax and spending bill that Republicans opposed. But the president walked back his remarks Saturday. Republican Senator Rob Portman says work on the bipartisan legislation can move forward. The last and only foreign scientist in Wuhan lab is speaking out to Bloomberg. Danielle Anderson was working at what has become the world's most notorious lab just weeks before the first known cases of COVID emerged in central China. The Australian virologist wonders if she missed something.
Of anything, scientists are gossipy and excited. So, yeah, nothing strange from my point of view going on at that point that would make you think, oh, something's going on here.
There's been speculation that the virus leaked from the Wuhan lab. The US has questioned whether the facility was safe. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We remain very optimistic. Very exciting yesterday to see Republicans and Democrats come together on an infrastructure plan that could be a game changer for American industry and for the American economy.
The administration is optimistic. That was Heather Boucher, the U.S. Council of Economic Advisors member from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Equity markets at 42.73 on the S&P, advancing about 2 points. We advanced 0.05%. Huge range on a 10-year Treasury last week. At the low end, 135.26. At the high end, 154.28. That's 19 basis points on the week. Right now, 150.71. Yeah. Yields in, Tom. 2 basis points.
We haven't talked enough about that, John. I mean, can you imagine if we go up 19 basis points from here?
That would be a big move, Tom. Yeah. And last week was a big move too. That 135 came early Monday, and then we moved on quickly.
Yeah, I mean, the dynamics here are really something. And again, my dynamic is Brent crude at $76 a barrel. Right now in the infrastructure debate, it would be good to get a little experience. We can do that with decades of work. William Hoagland joins us, the Bipartisan Policy Center Senior Vice President, with all sorts of tangible work over the decades with Capitol Hill, with the House, and with the Senate. Bill Hoagland, we don't want to pay for our infrastructure. At what point did we decide the gas tax was a bad idea?
I think that I think the president decided that when he decided that he would not want to raise taxes on anybody with incomes less than 400,000. I think that was the mark that resulted in there not being any increase in the gas tax. I agree with you, Tom. I think that's an obvious one. In the past, that's been one that we've used to fund our highway trust fund, but it obviously was tied up with the politics of not taxing anybody with incomes under 400,000.
Okay, but the critics here, Bill Hoagland, say simply the gas tax goes to other programs. Can they, in a bipartisan agreement, if they say the gas tax increase will all go to bridges, et cetera, is that doable?
Yes, it's absolutely doable. You can define where you want that revenue to go. It goes right now, it goes into the Highway Trust Fund. And you can make certain that money is spent specifically on highways and bridges, as example, without having to go to other things. You have a transit tax also that goes into a transit fund. So there are ways to handle that bipartisan-wise. I think that's a bogus argument that you can't do what you've just outlined, Tom.
But Bill, there is this larger argument, which is, do we really have to pay for anything anymore, given the fact that benchmark yields are so low, and they are around the world? And this goes to your more than 3 decades of service for the government, crafting budgets. Have we rethought the need to repay or actually fork over the cash for some of these programs based on the fact that bigger deficits haven't proven to be a liability for the nation?
Well, Lisa, I'm sorry, but I'm one of those who still believes that deficits and debt matter, and that while interest rates clearly are low right now, and this is a good time in terms of investments and going forward from the federal government's perspective, long term, I am not of the mindset that those interest rates won't climb back up. And once they climb back up, when you're running a total debt of well over $30 trillion, then the fastest growing component of the federal budget will not be Social Security or Medicare, but it will be just paying the interest on our public debt. So I'm sorry, I'm of that mindset, still believing that you have to pay for what you have to pay for this, even with the low interest rates that we have. And I think in many ways, the bipartisan agreement that was reached over last Thursday, off track on Friday, back on track yesterday and Saturday and Sunday, I think that there was an indication there's some desire to try to pay for it, even though the pay-fors, I think, are somewhat soft.
Do you think among the Republican members who you still do keep in contact with, do you think that they have rethought whether it's proper to have this low tax rate for corporations, whether they actually would be more amenable to the idea of raising those based on the steady trajectory downwards that we've seen over the past few decades?
Yeah, I think that depends what Republicans I talk to and their staffs particularly. I think there are some who would agree that there is a need for a readjustment of the corporate tax. I think we're probably, if we get to it in another bill called the reconciliation bill, I think you're going to see a movement, particularly in the area from going up to 25%, not the 28% on the corporate tax rate that the president's proposed. But I think you're going to find that there is going to be some pressure here to increase taxes and corporate taxes.
I mean, John, it's in the United Kingdom as well. The Hammersmith Bridge back to 1887 or whatever is basically completely broken down, and they can't get it done there, can they?
I love how you're complaining about this as if you've ever been south of the river in London. You ever been on that bridge, Tom?
Maybe, I don't know. I went to the Imperial War Museum.
Did you? Okay.
Yeah, I think that was south of the river.
Bill, let's go there. Not on this particular subtopic of the Hammersmith Bridge, but defining infrastructure seems to be a struggle right now. Have we done that now? Have we agreed on what infrastructure is?
I think we've agreed in a bipartisan manner that it's basic physical infrastructure that has a bipartisan support. There still is a lot of discussion and will continue to be this about other forms of, let's call it individual or personal infrastructure, child care, family paid leave, these kinds of provisions that some of the progressives in the Congress want to define, and which has been one of the issues over the weekend about the dividing the Republicans and the progressives from the Republicans in terms of what they want to put in. But I think for the current, and hopefully we'll be able to put this bill together, the Republicans in Congress, along with the Democrats and the leadership in Congress and the president. I think they've pretty well defined it as physical infrastructure, bridges, waterways, highways. I think it has been expanded to include, of course, issues associated with the broadband, but the individual infrastructure, the family plan that the president put forward, I think it's still up in the air as to whether that should be defined as infrastructure or not in the minds of a number of individuals within the Congress.
Bill, it's good to see you. We appreciate and value your time.
Bill, thank you.
Bill Hoagland, Bipartisan Policy Center Senior Vice President. So we have the core infrastructure bill, Lisa. We can agree on that. And then there's the social infrastructure bill that's going to be very separate.
Well, there was this idea that originally they came up with this agreement, and this is perhaps why the market didn't respond initially to this agreement. It was a bipartisan deal, $579 billion, rah, 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 they're going to get it done. But then there was this asterisk, they only have to pass a $6 trillion plan alongside it, and otherwise President Biden would veto the bipartisan bill. However, he's backtracked on that. Where we are, though, John, I still don't have a sense of where we are. Veto doesn't seem to be the word that's being used.
So the Biden veto's gone. Is the Pelosi veto still there?
Right now, the balance of power is there needs to be some other kind of plan to further Biden's agenda for more progressive Democrats to get on board.
Yeah, and by Pelosi veto, of course, what I mean by that is that Speaker Pelosi has basically said that she's not even going to look at this bill, Lisa, unless there's a much, much bigger one that comes along with it.
So what are we talking about here? Are we talking about a $579 billion bipartisan deal, or are we talking about a $6 trillion all-in package? I mean, really, this is really one reason why people are having a hard time knowing how to respond to this.
This is what we're talking about. Breaking news. Tom Keene has been south of the river.
Yeah, no, John from Leicester just emailed in and says IWM is south of...
Confirmation.
Is it Thames or Thames?
It's the Thames.
Okay, in Newport it's Thames. I get them mixed up.
42.73 on the S&P. All-time highs. Heard on radio, seen on TV. This is Bloomberg. From New York City, live on TV and radio for our audience worldwide. Good morning to you all. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Monday morning with equities at all-time highs and your S&P advancing just a little bit at 42.75, a lift of a little more than 1/10%. Yields coming in 2 basis points to 150.54 on a 10-year Treasury after a really big wide range on a 10-year through last week. And euro-dollar, Tom, just briefly, 119.15. Some weaker euro in the mix this morning. Euro-dollar down to 119.15 and off by about 0.2%.
Yeah, I think, John, you're right, but I'm thunderstruck by a 151 10-year. We'll see where that heads. This will be fun. Mario Gabelli with us right now, needs no introduction, with Gabelli Funds, and also, of course, his wonderful individual stock work. You sometimes see it in Barron's. We're thrilled that Mr. Gabelli could join us this morning. Mario, I'm going to stay on a stock theme, and I'm going to start out with your wheelhouse. Long ago and far away, you knew where a spark plug went. You knew the carburetors. You know the automobiles and the tractors. Case Holland is a bet on the American agriculture. You go long Case Holland. Why?
Well, I've got let's assume the stock market's flat for the next 2 years. Assume that the 10-year bond is 2.5. Assume corporate taxes are 25%. How do you make 50%? So I look for companies that can benefit from infrastructure. Case New Holland, even if there isn't any, the construction business will boom in part because of the tailwind of capex from corporations. Secondly, the agricultural ecosystem, farmers have underspent. But more importantly than that, Tom, more importantly, they want precision farming. That's the name of the game. Less water, more precise, less labor because your factories can do it autonomously. And then what you want to own is a company that basically also has an ability to do ESG. A new CEO, Scott Wine, came over from Polaris. And so Case New Holland at $15.50 with $1.25 in earnings in 2 years and a spinoff of their Iveco business, which is financial engineering. That's enough reasons. Own it and buy it.
Well, let's continue the theme here. Hyster-Yale. Most of our viewers and listeners don't know Hyster, Hyster. Hyster-Yale. That's not Amazon. What's the risk here of missing out on Amazon and Apple if I go into a Gabelli, Case Holland, or Hyster-Yale?
Well, the notion is that you basically have choice in life and choice in making 50%. Another one of my 50%ers, Tom, is a company called Grupo Televisa. But going back to Hyster-Yale, the stock's 73, there's 16 million shares. Rankin, who's a young guy at 79, same age as Biden, he basically is running the company, and they've put too much money without demonstrating the success in creating a hydrogen fuel for their forklift trucks, and then taking that skill set and moving it elsewhere. You know, it's a good bet on the recovery of their business, which benefits from the change in logistics. And the stock 73, we thought they would earn $5 in 2 years. We're still sticking with that. But that's not one of my nifty 50 for the moment. But it's an okay play from here, and we own it. We're nibbling at it again, and we own it, and we haven't sold much. It went from 60 to 100 back to 65 or 70 where it's trading now.
Let me pick up on a bigger theme for you. In The Graduate, the line, and this is from your notes, I just want to say one word to you, plastics. Today you say he would have said batteries. Why, Mario?
Well, that's a great point, John. Let's go back one giant step. What we have to do is love the planet, love the people in our planet, and look at the potential. In that regard, climate change requires renewables. That's wind, solar, transmission, where I have a bunch of companies that I like, cybersecurity, because there's some crazy organizations around the world that are unfettered, but also battery storage. And then on top of that, you have the EV dynamic, and that is, do you do lithium ion or do you lose solid state, or which of those two will work? How do you get fast charge? How do you get longer distance? How do you recycle it? So the battery is an important element in that ecosystem. We're having our 46 years of an auto conference. This time, last year was featuring 3 years ago, autonomous vehicles. Last year was pre-owned cars. And this year, it's going to be batteries. So I like that over the next 3 or 4 years. How do we get a major battery breakthrough? And companies like Berkshire Hathaway understand that, what they're doing in their field. And companies that provide lithium, like Albemarle and Livent and so on, benefit from that. And how do we do it in the U.S.?
Are you more interested in doing it then through the batteries, through the technology that goes into the car, or can you do it through the auto manufacturer? Which one is it, Mario?
The answer is that we look at the entire ecosystem. I'm just picking batteries because it was if you saw The Graduate, which was R-rated probably at the time, there was that scene in there where Dustin Hoffman has to confront the husband, or is confronted by the husband of, and without getting into details, for this is a family program, I think. That's it. So it's batteries is a good soundbite. You could have said removal of plastics, recycling of plastics. Got it. But I chose batteries because I spent my 55 years in the auto industry.
So, Mario, there is a question, if we want to go to The Graduate in parallels, where Dustin Hoffman was under the water blowing bubbles and sort of trying to reset his life. And there is a question as you try to look for bottom-up opportunities about how you even evaluate what's been priced in, because a lot of the companies that you're talking about, the industries, particularly within renewable energy and batteries, have been incredibly highly bid up because people agree with you. At what point is it too much, and has it been priced in?
You always look at value versus price. I think you'll make a significant 50% in 4 years. I'll give you the 4 names, and then you can pick whatever you want. I gave you Case New Holland. I give you Grupo Television because the Spanish market is doing well. The good management, the financial engineering, they're converting it with Univision, and Univision's going public sometime in the next 6 months. And then you have, in addition to that, a company that's buying at a bargain price, going back to your EV notion, electric vehicles for the last mile, electric vehicles, period, electric trucks. Company Volkswagen spun off their truck business, Traton, but they have a lot of that intellectual capacity, and they're buying at a bargain price Navistar, which is closing shortly. Traton is selling at 28 euros. They're going to earn $4 plus, and you've got a good play, and, the stock is a 50%er in 2 years. So, there's a lot of ways to participate at the margins on some of these stocks, and then obviously you got to play baseball at this time of year. So you don't need to say what's overpriced in this market. What happens when the government comes in with a $6.2 trillion expenditure and raise only $4 trillion, and we got an increased deficit? We think about those things, but we look at companies, Lisa, with a microscope, and then we look and step back with a telescope and say, what's going to work 2 years from now? Some of these stocks we don't chase, and nor did we go short Nikola or and so on.
So I will let you talk about the opportunities in baseball with Tom, and I'm sure that you have things to sell him for his triple leverage cash fund. There is a question, though, about concentration, especially as someone who has been bottom up for so many years. Do you have more confidence in a higher degree of concentration in your portfolio, if you can do the analysis, than you have in the past, just based on where we are in the credit cycle?
Well, you take our small cap fund, okay? We love the ignored and unloved. And so when we go see a company, and by the way, finally getting out to see 3 or 4 companies, I saw one that's not in small cap, IT&T. You listen to that story, you listen to how management is executing, you listen to how every day they come in and they work their fannies off for the economy, for the company, for their shareholders, and for their constituents. So there's a lot of companies that are not fully understood because of the new dynamics in the market, Momo, algos, obviously, and so on. And then there's a lot of risks. The risks that you point out, I worry about the high margin requirements. Should we increase the margin requirement? I worry about shadow banking. The Dodd-Frank, today you guys are talking about the huge amount of money coming in by the banks this afternoon or tomorrow. But it's in part, they were reined in by Dodd-Frank. Give Dodd-Frank some credits. In addition to that, so we look at the valuations and we look at what is the present value of the future stream and who's going to buy the company.
Right.
Lisa, think about SPACs, think about strategics buying companies with their stocks at these prices, using it as a currency, and even companies that we like are selling converts with a 1% coupon up 40% to raise money.
Mario, I want to talk about the heart and soul of the matter, particularly going into this earnings season. And this goes back to the wonderful Jack Welch. The idea of pricing power. Revenues are made up of a unit dynamic and a price dynamic. Are we going to have pricing power and unit growth to go with it?
That's a good question, Tom. The way we look at the model is everybody talks 7% GDP growth, but that's real. You got 3% inflation. Revenues are going to grow 10%. So if I was the only company in the United States, I'm going to have 10% revenue increase, and I'm going to basically look for improvement in 2022, in part because of the lag effect of certain companies coming through. But if I have a surge in my cost, which is crimping my gross margin, can I pass through my cost with the margin maintained? There are companies that can do that. SG&A is not going to rise 10%. So I have an increase in pre-tax margin, and then I'm going to get hurt by taxes, and I'm going to be hurt by an increase in the multiple.
But Mario, the heart of the matter here, and this goes back to the religion of Gabelli, is I want my cash back. I want dividend growth. I want share buyback. Do you see any change in use of cash dynamics?
Yeah, I'm not a big fan of cash buyback. And if corporate dip, if you're going to pay 40% on dividends and you got a SALT tax that adds 13, and then you got the Obama tax on top of that, you're going to keep 30%. And that's a triple tax on shareholders. No, I'm not a big fan of dividends. I like the Buffett approach. Get good managements that compound. Yes, he's buying back stock because it's selling well below intrinsic value. But Tom, a year ago when I was on a program, we had shortages. People were concerned about financial liquidity. Today, they're not as concerned about that. They want supply. They're over-ordering, and you're going to see some of that. And the surge in prices, you saw lumber come down from $1,700 to $800. But you're going to have wage increases because there's a shortage of labor, and that gives you your wage push element to inflation, and that's what we have to be sensitive about. And one of my directors, Carl Pearl, when he was head of the Bundesbank, said, it's like inflation is like toothpaste. Once it gets out, it's very hard to put it back in the tube. So we have to be super sensitive. At what point does Powell lift his foot off the accelerator on financial dynamics in terms of pumping money into the system, and how will the market react? But that's just a short-term pothole in the next 10-year voyage for stock ownership.
Mario, let's not wait another year before we talk again. It's great to catch up, sir, as always. Mario Gabelli there, Gabelli Fund CEO and Chairman. Pricing power, a big issue there, TK, and it's a big issue for a lot of people looking at this equity market.
And I know we're going to get through jobs, and we're going to do that on Friday, and we'll figure taper this, taper that. John, the mystery right now is the difference of opinions we see on Bloomberg surveillance on what earnings will be. Yes, June 30 end, you'll see them in 30 days, but really the next quarter on and the next quarter on from that, there is a raging debate, and Gabelli's clearly on the side of that. They're going to be positive.
Margins, Lisa, and they were resilient through Q1. Will that be true of 2, 2, 3, and 4.
Especially as we see certain commodity prices actually come off their highs earlier in the year. Does that actually give a boost to margins beyond what people were expecting, or are higher wages going to eat into it? And I do wonder how much people have accounted for some of these wage increases we've seen, particularly in the restaurant industry.
So everyone's talking about peak everything. Have we seen peak inflation fears? Can we say that yet?
I mean, are you willing to say that? I'm not willing to say that yet. I'm not going to weigh in.
Look at where the price action is. Look at where break-evens are. Can we make that point?
Yes.
Can we make that point based on market perceptions of inflation, price pressure?
What's interesting is that you could see it in the bond market. In stock markets, and certainly among analysts, you do not hear that belief. We do think that there is this sort of percolating inflation fear out there.
It's the gloom, John, of the pendulum.
I don't know if that was too gloomy, but I'm with you.
The pendulum of margins.
Usually Lisa is gloomy. I'm not sure if that was too gloomy. I think when you do talk to equity investors, they seem to be very, very laser focused on cost and pricing power and where that shows up in a more acute way in which sectors.
I can't give my opinion here. It's not. We're not supposed to give our opinion.
When have you held back from giving back your opinion on anything?
The closest I'm going to come to opinion is a lot of research. The lobster supply is off in Maine this year.
Okay.
It's a little bit ebbed.
This trip, we're not going to hear the end of it, are we?
No.
You going away again this summer, or is this it?
No, I think it's
4 days in May.
It's it.
We're done.
You've got another 3 weeks vacation coming, so, I got to be here to take care of that.
Oh, TK, you and I are having words. 42.76 on the S&P. Coming up.
Are they going to put us in the same bar for Germany, England?
I don't think you are allowed in the same room. Do you think they'll let that happen in a pub?
I don't know.
Coming up on the Open, State Street Global Advisor CIO Laurie Heinel. Looking forward to that. From New York City this morning, good morning. On TV, on radio, this is Bloomberg.
I don't think inflation is going to be transitory. If we do get wage growth, which I think is coming, I think inflation is going to be a problem. When people have more money and it costs more to produce a few things, it's going to come through in higher prices.
Patrick Armstrong there on the pace of the market as well. Futures up 5, Dow futures negative 16. NASDAQ futures resilient through the morning, even on a little bit of a movement. Of course, Jobs Day on Friday. We'll have all that coverage for you. Lisa Abramowicz and Tom Keene, and with us right now, we start strong on the 100th anniversary of the Chinese Communist Party. Tom Orlik joins us to say he's Bloomberg Economics chief economist. Doesn't describe his China knowledge, the bubble that never pops. Got rave reviews out on Oxford here in the recent months. Tom Orlik, thank you so much for joining. I just want to go to your book where you talk about the fourth cycle we're in right now. How does President Xi get his Communist Party to the fifth cycle?
Yeah, it's a great question, Tom. And this 100th year anniversary of the Communist Party on July the 1st is going to be primarily, of course, a celebration of success and development in the last 40 years. But looking forward, there's opportunities, huge investment in technology, efforts to boost fertility to offset the demographic drag from the one-child policy. Xi will hope that he can deliver on his objective of doubling the size of the economy again by 2035, but also some huge challenges, the overhang of debt, the slowdown in reform of the state sector, and, of course, decoupling from the United States and its allies, which threatens to slow the cross-border flow of ideas, which has been a real driver of China's development.
Tom, if you're on the Bund in Shanghai and you wander back on one of those streets, you move back to the French concession where all the West had their own unique neighborhood. And there in 1921, I've been to the house. It's a museum now of the history of the Communist Party. How attached is that museum and all it represents? How attached is it to the Chinese people?
It's a great question, Tom. And I think when the Communist Party look back on their last 100 years, they're going to be celebrating a lot of successes. They're going to be celebrating their success in kicking the Japanese out in the period around World War II. They're going to be celebrating the success of Deng Xiaoping and his reforms, which have lifted China up to global GDP rankings over the last 40 years. What we're going to hear less about in that history of the last 100 years is some of the missteps. We won't hear much about the Great Leap Forward. We won't hear much about the Cultural Revolution. We won't hear much about events today in Xinjiang. And I think for the rest of the world, this is a kind of a reminder that when a single-party state gets it right, they can deliver enormous benefits. When they get it wrong, there can be some really serious missteps.
Tom, how much does China want to sort of emphasize the communist shift behind this party versus the more democratic and, frankly, capitalistic shift that you've seen the nation take on?
So I think that here in the West, Lisa, we think that the recipe for success in China is going to be to move closer to the Western model, right? We think a China which is democratic, a China which is more market-oriented, is the only China which is going to succeed in the 21st century. That's not the view of the Chinese Communist Party. That's not the view of Xi Jinping. Especially looking through the lens of the COVID crisis, what they see is that democracies and markets failed, and the Chinese Communist Party succeeded, controlling the virus, getting the economy going again. They think that the events of the COVID year, the events of the last 100 years, demonstrate the success of their governance model. They're going to be doubling down on it, doubling down on their political model and their economic model as they go forwards.
Tom, is the CCP gaining popular support among the rank and file in China or losing it?
So, I mean, that's really an extremely difficult question to answer, Lisa. There's no elections in China. There's a limited role for the press in China. We don't have opinion polls out of China. What I can say, though, is that a party which delivers very, very substantial increases, improvements in the quality of life, the quality of living for a very, very large share of the population, typically enjoys some solid support, and I think that captures the situation in China.
Tell me about the reach of the Communist Party outside China, very quickly here, Tom. How powerful are they in a traditional communist rhetoric?
So I think we have to draw a distinction between the old USSR, which wanted to spread communism, and the modern Chinese Communist Party, which wants to increase Chinese influence, but doesn't really care so much about the ideological component of it. So yes, we've got the Belt and Road spreading Chinese funding and Chinese political influence around the world. But are the countries which take that Belt and Road funding moving towards a kind of a communist ideology? No, not really. They're aligning more with China's global interests. But Beijing doesn't really care whether they move on to a kind of Mao Zedong, Chairman Marx, Mao Zedong, Karl Marx type trajectory.
Tom, I'm going to leave it there. Thank you so much. Wonderful to start our coverage here of what we see July 1st with Mr. Orlik. I can't say enough about his book, which is piercing, got rave reviews. Its immediacy, his journalism in China. Lisa, you know, it's sort of a sideshow to all that's going on here, but it's 100 years on from something that changed the world, whether you agree or not with their themes.
And perhaps this sideshow is very much front and center when it talks to the rebalancing of geopolitical power at a time when the East versus the West is taking on a very different tone, and President Biden is trying to gain some of the alliances back in order to come up with a strategy to counter China. I mean, this, to me, is very much in the front and center.
And you wonder, after the president's trip to Europe and the perceived success of that, what will it be like when we see a Biden on the Pacific Rim here?
Yeah.
I believe that's scheduled out there. As well. Lisa, I thought Brill was brilliant.
He was, well.
I'm sorry.
It is. I have to offer up a surveillance correction, because Canada called and they were put off when I said that it was a less vaccinated region than the rest of the world, because actually they are now leading in the number of first shots, percentage of first shots doled out to its citizens, with about 3/4 of the population having received at least one shot. Versus, but that said, fully vaccinated, not as much as the U.S. and Israel and certain places in the European Union, but it shows, frankly, the insecurity around needing to get a certain proportion of the population vaccinated in order to entice travelers, in order to entice business.
Now, you know, to save yourself further, Canada, Corey Price looks awfully good tonight against Tampa, doesn't he?
Oh, yeah, I'm following that game closely. This is my sports space. I can talk as intelligibly about hockey as you can about football.
The clock can't move fast enough. We start on Monday and we go through the week. Important economic data. Jobs day on Friday. Within that, well, it's a bull market. NASDAQ 100 out to highs for the day. Up fractionally, but nevertheless, there it is. Up. Please stay with us. Adam Posen coming up. This is Bloomberg. Good morning.